Hi guys, I think I'm live. We'll roll with it anyway. It says I'm live. Okay, guys. There's so much to talk about. I don't even know where to start. But I wanted to follow on from last week's the last live stream that we done. Today's a perfect day to do it. I wasn't expecting it, but we had a sort of pivot from the United Kingdom. Bank of England decided to do quantitative easing again. So now we have QE that's not really QE by the ECB, $1.5 trillion for energy bailouts. We've got the Bank of Japan, who really don't give a shit. They're doing curve control and they're calling it quantitative easing, and they've just been doing that for however long. And now you got the Bank of England, less than a week after raising interest rates. They're doing £5 billion a day of quantitative easing in perpetuity. They didn't give an end to it. They're bailing out the system as of right now. And this is the main reason why I stay long equities. There is sort of no alternative in that sense. Cash is trash is essentially what I mean. And all this year has been very frustrating to me because we're really pushing on a string in terms of the amount of tightening that we can actually do. And it's getting to a point where there's a lot of systemic risk. And I will admit that after the core CPI print that came out at 6.3%, Fed continued to harp on about 2% inflation targeted rate. And now you have a potential sovereign debt crisis, not in an emerging market economy, but in a G5 economy. And it's largely driven by energy and the dollar, which we're going to go over today. And we're also going to analyze the balance sheet and the income statement of the US government, because the US government's bankrupt, right? So if we're in a situation where base money has to continue to grow, M2 money has to continue to grow, inflation is going to be a lot higher than interest rates. Otherwise, the system ends. And if the system ends, I mean, it doesn't matter if you have FDIC insurance or whatever it is, you ain't getting insurance from the government. It just doesn't exist because they've defaulted on their debt. And so my view is having a claim on a specific business that has some sort of productive uses, whether it's, manufacturing lawnmowers for grass that won't stop growing, or whether it's chemicals for pools, or whether it's, HVAC systems in the winter or the summer. And so my view has always been, if we own companies with some degree of non-discretionary spend, we should do perfectly fine. It is really important to understand, though, that the crisis that we're seeing at the moment is not due to the household. I think people are starting to realize that. What we've seen so far this year is pretty much, like if you look at this chart here, all we've seen this year is pretty much what's known as a re-rating of multiples, essentially. Neutral rate increases. And what happens is, as you can see, EPS hasn't come down because the consumer is still spending. The households are still in pretty good shape. EPS is a dark blue line here. It's holding up really, really well. What's ended up happening is we've had a re-rating of the multiple that we pay for these stocks simply because interest rates, the neutral rate increased. And that's the story that we've seen this year. It's not been a weak economy. It's not been a weak household. It's not been weak spending. It's been a re-rating of risk due to high interest rates. So you can continue to see that. So on the 15th of September, you had Ryan McInerney, who's the president of Visa, came out. And I always read these sort of reports because they give you an idea into how the consumers doing? Like, what are they spending money on? It gives you an idea of whether the consumer is starting to slow down. And on the 15th of September, for context, today is the 28th of September, it was 2 weeks ago. But this is essentially what Ryan had said in this conference. He said overall spending has been remarkably stable both in the United States and abroad. But what consumers are spending money on is interesting because it tells you a lot about their current circumstances. You're seeing that there is strengthening of discretionary segments. Now, discretionary essentially means, it's discretionary. You don't necessarily need it. Like, go to the cinema. That would be discretionary. I don't need to go to the cinema. So if I'm squeezed for cash, I'm not going to go to the cinema, essentially. So what we're seeing is strengthening of discretionary spending, which is very interesting from consumers at a time where people are still harping on about how bad the economy is actually in. And what's also interesting is a portfolio company of ours, PayPal, they were also involved in a conference on the 13th of September. And what the CEO actually said was, you're seeing a lot easier comps, right? So April was growth of 7% year on year. May 10%, June 12%, July 14%. Comps are getting easier. Growth is starting to pick back up again. And if you pop down here, you'll see that essentially a little bit further here, but essentially what the CEO said was that they're beating anyway. Yeah, here it is here. So, well, there's that's Venmo, maybe a little bit lower. Anyway, essentially says that they're in line to they're in line to beat EPS anyway, earnings per share. Here it is here. Actually, EPS looks to be coming in a bit stronger than we anticipated for the quarter. So why is that important? Well, PayPal are essentially a merchant. They make their money on transactions. Transactions are quite high, and they're looking at beating their anticipated EPS for the quarter. Now, this is a little 3 weeks earlier, but for the quarter up until that point, the 13th of September, just 2 weeks ago, PayPal's kicking butt, Visa's kicking butt, the consumer is still spending. And as well as that, if you look at, for argument's sake, companies that we own, the Taro company would be an example. The Taro company essentially sell lawnmowers, irrigation systems, turf, that type of stuff. These guys on the 1st of September had their earnings call. And what you'll see here is they actually upgraded. In July, recently we hosted, maybe I won't find it here, but essentially they upgraded their guidance with a strong operational execution. They upgraded guidance anyway. They beat and they raised on the latest quarter due to a strong underpinning customer, both on the service segment and from the retail segment. So every company that we've seen up until the present day has been performing very well, including companies like Transocean. Despite the price of crude oil going lower, what we're seeing from companies like Transocean is that they continue to win new contracts. So the fundamentals of these businesses not changing. The consumer up until the present day has continued to spend money, yet the share price of these companies continue to push lower. And as you can see here, it's largely been a re-rating of risk. And that's because the market's concerned that interest rates will be stubbornly high while we have inflation. And I believe, or my bet anyway, is that that's likely going to be a near-term phenomenon, but it's going to reset. And today we had the Bank of England, which we'll talk about in a moment, reverse on QE. It's a pretty decent day. I don't think it's going to be the bottom yet, but we'll talk about that in a moment. But as you can see here, despite all this, 22nd of September announces a new contract. On the 6th of September, a new contract, 181 million. The backlog of order continued to grow throughout September. And despite higher interest rates, they're able to refinance as well, pay down high interest rate debt, shore up $175 million here as well. As you can see, $175 million of liquidity by retiring 7.25% senior notes and whatnot. The fundamentals of these businesses are still very strong. Consumer continues to spend, yet the market continues to push lower. It's really an interest rate phenomenon, but we're at a very critical and risky point as of right now. And I am concerned in the near term, but I do believe that the Federal Reserve will pivot sooner rather than later. So I want to show you guys this, and we're going to go over sort of what normally happens in an emerging market economy. A lot of people are calling the United Kingdom an emerging market economy. Sovereign debt risk is increasing, and you can see that in the way financial assets are actually trading in the United Kingdom, which we're going to look at the moment. This is on the 22nd of September, less than 7 days ago, last Thursday. The Bank of England raised interest rates to 2.25%. 6 days ago, they raised interest rates. Tomorrow, Thursday, they had a meeting, a public meeting to talk about how they're going to run off their balance sheet, how essentially they're going to do quantitative tightening. They canceled tomorrow's meeting, and yes, you guessed it, they started quantitative easing this morning. So they started quantitative easing, and the question is why? Debt levels are way too high. As you start to push up interest rates, you end up essentially breaking things. At the same time, Liz Truss, her government are essentially doing fiscal stimulus, cutting taxes, precisely the wrong moment to do it. And so you have this massive balance of payment issue. And then you have a massive freezing within your bond market. As you can see here, this is a G5 country's bonds. This is what they're trading like. This is like essentially an emerging market economy that is essentially, default risk is exploding. That's essentially how the United Kingdom is trading. This was their bonds. It's up today. 10-year gilts are up about 5-6% on the day because of quantitative easing. And essentially, the Bank of England will be buying £5 billion every day in perpetuity. There was no end date. So unlimited QE. And this is the reason why I want to own equities. When you have higher inflation, base money continues to explode, and you leave your money in the bank at a 0% interest, it becomes highly risky. Now, for the first 9 months of this year, the market believed that we could have and sustain higher interest rates. Things have broken. And as you can see, we're now in a situation where it's not Sri Lanka that has the sovereign debt issue. It's the United Kingdom, which is kind of scary. The challenge that we have with the United Kingdom is twofold. It's not Brexit. The problem with the United Kingdom, that might have compounded things a little bit, but that's not necessarily why we're falling apart here. The reason why we're falling apart in the United Kingdom is, first and foremost, inflationary pressures driven by energy, and secondly, a strong US dollar. Why? 1971, we had the Bretton Woods Agreement. Bretton Woods Agreement, essentially, in very short, was we all agreed to use the US dollar, and the United States, so that was the reserve currency, and the United States military protects those trade lines. Well, that's essentially why they're in the Middle East, and that's essentially why the US military is so goddamn big. But those trade lines haven't necessarily been protected, certainly with Russia going rogue. And US dollars are very tight with the Federal Reserve raising interest rates. The reason why that's important is because the United Kingdom is short energy, and they need US dollars in order to buy that energy. And they don't have them. And as the dollar gets more and more expensive, essentially what ended up happening was big, massive stresses because a runaway US dollar, which is up against every single currency, not the British pound, not just the British pound. It's down. The Japanese yen's down 25%. The euro's down 15%. The Australian dollar is down about 12%. Every currency is down against the US dollar, which we'll get to in a moment. This is where it gets a little bit concerning, right? So when we look at sovereign bonds, when you start to see interest rates and sovereign bonds push higher, and at the same time, GBP, and at the same time, you see the price of gold in your local currency push higher, essentially what this is telling you is that the market is incredibly concerned about sovereign debt risk within your US Treasury market. Confidence within the United Kingdom is at an all-time low. And you're seeing at the moment that gold priced in British pounds is up 13%, while gilts are down something like 25% on the year. It's a massive mega risk, and you still haven't solved the issue of higher interest rates and a shortage of oil. So this is where the challenge is, because that paper becomes worthless and real assets become very valuable. Now, if you go and you have a look at Turkey, for argument's sake, inflation's at, I think, something like 80 to 100%. If you look at the Turkish lira, I mean, this is hilarious, but this is essentially what's gone on. 800% up since 2014, the US dollar against the Turkish lira. Why? Well, you have high inflation. They continue to insist on cutting interest rates, and then the currency gets absolutely blown up. And what ends up happening is you have to do something with your cash. And in a lot of cases, that cash would flow into real assets. So over the same time horizon, gold in Turkish lira terms is up 10x, whereas the currency is US dollars up about 8x. So dollars over that period, or gold over that period, not just preserved wealth, but it also exceeded expectations in terms of preserving capital. I think equities in developed markets, we've seen it during Weimar Republic, inflation blows out, developed market economies, which that was the case back in the early 1900s in Germany before Hitler took over. There was a democratic sort of system there as well. But if you go back to that period, we had a situation where the German market actually exploded higher with inflation. And you made a lot of money owning equities, and that's essentially why I want to own equities right now. I believe that volatility increases significantly. And I mentioned this in Q3 and Q4 calls last year. Volatility is likely going to be sticky. There's going to be a hell of a lot of uncertainty. I didn't anticipate we'd get as deep as we are right now. And the question is, why do we get so deep in the market? We got so deep because interest rates got so high in terms of expectations anyway. So if we have a look at where the Fed funds rate is expected to fall, as of right now, the market favors 75 basis points next month. That's flopping all over the place. That was, 60% here a little bit earlier. It's quite volatile at the moment. So we'll see how that reacts over the next couple of days. But for November, as of right now, 75 basis points, another 50 basis points in December. And then it's flat into March and then up to 4.5, 4.75. I don't think we're getting up there. And so this is the next part. Why do I want to stay long equities? We know the household's in reasonably good shape. $2.7 trillion in net cash is what the household consumer is sitting on. 40% of mortgages in the 40% of households have no mortgage, which means that household equity is at 72%, 65% home ownership, and over 90% of those homeowners have a fixed rate mortgage of 3.3%. So they're harvesting yield. Why? Because wage growth's at 6.7% and they're only paying 3.3% fixed every year on that mortgage. So their home has gone from a liability to an asset overnight because of the current circumstance. US consumers in really good shape, but the sovereign's in terrible shape. So let's have a look at their balance sheet, which is absolutely toxic. If any of you guys are accountants out there, look away. You're about to see a car crash here. So this is Bureau of Financial Services for the United States. And they break down every year what the balance sheet and the income statement and the cash flow statements are for the US government. So we can analyze this like we'd analyze a company. As you can see here, assets, the asset segment of the balance sheet is $4.8 trillion. The liabilities segment is $34.7 trillion. They've got a deficit in terms of their balance sheet. They're essentially, their shareholder equity is negative $30 trillion on the balance sheet. They've got 30 trillion more in essentially liabilities relative to their assets. Right away, that is a company that's destined for bankruptcy. Destined for bankruptcy. Let's have a look at their income statement. The income statement is, they usually comprise just over a 75-year time horizon. And you might say 75 years, why would you look at 75 years? It's never going to be correct. Well, we know on average the population growth. We know on average how many people enter the workforce, and we know on average the wage growth, and we know on average how long somebody works to about 61 years of age. So you can project into the future on average, because you've got a sample size of over 160 million people in the workforce, you got a reasonably good projection of these numbers, because your data set is 160 million people, and it's 340 million for the entire population. So they project 75 years into the future, which is one entire life. And the reason being is it gives you an idea of what the liabilities are in terms of unfunded liabilities, which we're going to look at in a moment, and the expected income. So where we are as of right now, total receipts over the next 75 years is expected to be somewhere in the region of $332.8 trillion. The non-interest spending, so this is not even factoring in debt or interest on that debt, which is going to be very important, is 430 trillion, meaning over the next 75 years, the US government has a shortfall of close to $100 trillion. What that means is we need to issue a deficit of 1.3 trillion every single year for the next 75 years. The reason why this is so critical is the Federal Reserve in the US want to do quantitative tightening. They won't be able to do it. That's essentially putting their $8.8 trillion balance sheet up for sale. At the same time, what we're seeing from international markets, look at Japan as an example. What did Japan do to intervene in the currency? They're the largest owner of US treasuries. They've got $1.3 trillion in US treasuries. What did they do in order to protect their currency? They sold off the US dollar assets, raised some dollars, protect their currency. So now you have $7.5 trillion from international institutions, whether it's governments or whether it's banks or commercial banks. They're all selling their US treasuries as of right now to raise dollars because the dollar is so high. So you got $7.5 trillion offshore for sale. And at the same time, you've got $1.3 trillion that's being issued by the US government. So we have a bankrupt US government because there's no natural buyer. So the only way in which we can get out of this is essentially what we spoke about in the last live stream. It's the Federal Reserve will have to conduct yield curve controls similar to what they done back in the 1940s, where you have a positive fixed rate slope essentially on the curve. Fixed back in the 1940s at 3.75% on the low end. I don't know where that's going to be today. And on the long end, 2.6%. The reason why that's important is to have a positive yield, it would essentially force the US government and governments internationally, if there's a positive yield on that slope, it would force them to be more fiscally conservative. Because the governments, this is the problem with MMT, modern money theory. The cornerstone of modern money theory where it's wrong is you're betting on the US government or any government that's conducting modern money theory to be a good allocator of capital. So go back to 2020 and let's try and digest where the US government spent some of that $7 trillion in fiscal stimulus. Well, they offered everyone a burger and chips to go and get a COVID vaccine. Here's $1 billion down the toilet. And so when you have interest rates at zero and a natural, essentially, buyer of bonds in the Federal Reserve constantly buying those bonds, you have stupid policy like, let's give somebody a burger to go and get a COVID vaccine. It's crazy. And that's what we've seen in 2020. So you need a positive sloping yield curve like what you seen back in the 1940s. And then from there, I think we can start to solve an awful lot of the issues. Main takeaway is the US government are essentially they're spending $1.3 trillion more than they bring in on average over the next 75 years while they've got a bankrupt balance sheet. And there's no natural buyer. So the only way out of this is either the system goes to zero, and it doesn't matter where you have your money, it's all going to go to zero. Whether it's in a bank account, your FDIC insurance is not paying out if the US government defaults on their debt. If it's in gold and it's through a broker and you own physical gold, fair enough. Maybe you'll be able to get away okay. But anyway, what I'm trying to say is what the Bank of England have told us is they're not going to risk the entire system. They might be dumb, but they're not going to blow up the system. Winston Churchill said that the United States always do the right thing after they try everything else first. And that's essentially what I think is occurring. But the US, the Federal Reserve, and Janet Yellen came out and said that the US bond market is not disorderly. That's what she said yesterday. And if you look at long-dated treasuries, they're falling off a cliff. So as of right now, why have we not this is, I think, one of the reasons why I was so surprised why we could be so hawkish for so long. One of the reasons why I think we could be so hawkish for so long is the Treasury General Account, which is the United States government's bank balance essentially right now, has $6.92 billion in it. We had a massive tax collection earlier this year, not happening next year. It's not, all assets are down. The Federal Reserve, let's pop on over here and let's have a look at the income statement. Where's the vast majority of income coming from? It's expected to come from individual income tax. Now, think about how dumb it sounds when Jerome Powell comes out and says we need to get unemployment up. So most of the income that the US government has, and they're already underfunded, comes from individual income tax. And the Federal Reserve are saying, oh yeah, you guys can't even afford to pay me back, so let's make it more difficult. That's how dumb it is, right? And so I think what's happening right now is you got a very incompetent Federal Reserve. And I up until 4 to 6 weeks ago, I would have said the Federal Reserve was not incompetent. I thought they were doing a fabulous job. And the reason being is they were staying so far behind the curve that you were seeing the Federal Reserve monetize debt. And that's essentially what we needed to see. So I thought these guys were well ahead of their game, really understood what they're doing. Now it's very apparent. I don't know if you guys seen that skit from Jeremy Siegel on CNBC. He's 100% right. Siegel was on CNBC a year ago saying that the Federal Reserve will not recognize higher inflation because they're looking at the wrong metrics. He said they're going to make a big mistake, and they did. They ran too hot for too long, and now they're going too tight for too long. There is limitations to this. Things are starting to break, but as we've seen already, we have the European Central Bank, who are already doing quantitative easing, $1.5 trillion for energy bailouts. That's not really quantitative easing. There's a different name every single time they do it. There's a different name on it. Bank of England are now doing £5 billion per day. The Bank of Japan they've never started doing curve control. They've never stopped. They can't stop. They've got 266% debt to GDP. Can't stop. Can't raise rates. They're in a very difficult situation. But you're starting to see slowly central banks roll over. Sweden came out. Sweden raised interest rates and said nothing. Then they gave their forward guidance. No more rate hikes. Rate hikes are done. Internationally, you're starting to see a rollover. And the main reason for that is high dollar is absolutely pulverized developed markets. And you can see that in the currencies. So if you have a look at whether it's the euro, just absolutely collapsing. And what's very interesting is, where did all this collapse start? All of these started to collapse on the 13th of September. 13th of September, big sharp move on the downside. 13th of September. What happened on the 13th of September? Well, we had core CPI and headline CPI came in a little bit hotter than expected. And then you had Fed presidents on the day come out and say they're still expecting 2% inflation, which you're not going to get. And what that does is it creates this policy error. Interest rates absolutely blow off. And it's kind of scary because there's a high degree of incompetence as of right now. I don't think it's a secret. I think everybody's looking in shock at the moment how the central bank missed essentially COVID, overstimulated, and now they're over tightening. It's definitely damaging their credibility. And when you have a central bank that raises interest rates a week ago, 6 days ago, raises interest rates 50 basis points to 2.25%, only 6 days later to have to intervene and start quantitative easing again and cancel their meeting to talk about running off the balance sheet, that's the system we're in. So the reason why I'm more bullish is, what do you do with your wealth? How do you protect yourself? Okay, one way you could do is you can go out and buy gold if you want. That's perfectly fine. I think that quantitative easing is a feature, not a bug of the economy. And despite higher inflation, I don't think governments can essentially fight off inflation. And the reason being, it's structural. Most of the inflation that's likely going to permeate over the next number of years is wage growth. And the reason why wage growth is going to continue to permeate and stay relatively high is because we've got 12 million workers less in the labor market. And wage growth is absolutely spiraling. So everything else is rolled over, like energy is rolled over. If you look at, one thing I couldn't stop laughing. There was a Fed chair out the other day that said we're pretty close to the peak of inflation. 66% of inflation on the headline number in June came from gasoline. It was 108% year on year. Since then, it's down 50%. It's not just gasoline. Like if you look at the input prices for building a home, lumber is down 54%, more than that now, but lumber is down 61% year to date. You're seeing all these commodities, copper is another one. All these commodities are down pretty significantly year over year. I think we're starting to put in a low here, which we'll talk about in a moment. But all of these commodities have already rolled over, and it's year over year rate of change basis. So the comps on the headline number for CPI is going to come in softer and softer and softer. And here's the tragic part about the Federal Reserve: they're following shelter costs, which is 43% of core CPI. So when I say that the Federal Reserve are very incompetent, this is essentially what I mean. How is core CPI? How is shelter for core CPI data collected? This is a tragic part. No, not here. Frequently asked questions. What's inside? Will I find it right now? That's the how is shelter. I did search it not that long ago. How is shelter calculated? I think it's this one here. So this is the biggest challenge, because rents are essentially, if we go down here, you'll see that the sample data is collected every 6 months, right? So CPI program collects rent data for each sampled unit every 6 months. So it's very lagging. It's lagging 12 to 18 months into the future. So the CPI that the Federal Reserve are looking at, which is OER, owner's equivalent rent, is out of date by 12 months. The next time we're going to get, so we just got the latest data for panel 2 in August. The next data set we're going to get is going to be January for panel 1. So the inflationary data that the Fed are looking at is like months old. It's going to be way out of date. And so you have a challenge where last year they were way behind the curve. I thought that was smart at the time. Now I'm beginning to realize that they're just following the wrong data. That's really, really, really concerning. That's essentially what led to interest rates blowing up. So if you pop on over here and you have a look at compare, and you have a look at, let's say, March 2023, current versus 1 month ago. So 1 month ago, the peak was at 3.75 to 4%. And then on the 13th of September, it completely blew out and moved to the right. Up, it was as high as 1% since then. As of right now, it's looking more like 75 basis points, 50 basis points, but it's significantly higher anyway. And the reason why we have much higher interest rates is because the market expects the Federal Reserve want 2% inflation, which you're not getting because of wages. That's the challenge. So when you break it all down and you try and wonder, like, where do we currently stand? Well, look at the performance of our businesses. We're seeing fiscal drag, which can shrink the economy. But if you look at the Taro company, which is the latest company to report, a beat and raise on the back of strong demand. If you look at Applied Materials, the next 3 quarters, demand outshines supply. There's not enough supply to meet demand over the next 3 quarters. They know that through the backlog of orders. If you look at Visa's latest data from 2 weeks ago, consumers spending a lot of money on discretionary. If you look at PayPal saying on the 13th that they're ahead on EPS at that point, it's a couple of weeks still to go in the quarter, but up until that point, their EPS is better than expected. If you look at new home sales, the data that came out yesterday, we're expecting 500,000, came in at 685,000. And every incremental change you see in interest rates, because demand is quite high, every small incremental change that you see is going to massively impact the housing market and anything that's rate sensitive. And that's where the portfolio is so concentrated. That's essentially where I concentrated the capital in the portfolio, because I don't think interest rates can remain quite elevated. And today is the first time in a while where interest rates are down. And if you have a look at the performance, the top performers in the portfolio, okay, take Transocean out, but you've got CleanSpark, Overstock, Builders FirstSource. Look at those 3 there. You have MI Homes, home builder, you have a home supplier, and you got a furniture company. 3 of the top 5 are up over 5% on the day because interest rates are pushing lower. My view is that interest rates can't go much higher than where we currently are for the reasons I mentioned a moment ago. You have a bankrupted U.S. government. And this chart here is term premia as calculated by the Federal Reserve, 10-year Treasury term premia. Now, I don't know where the latest data we have is last July, but Michael Howell has recently said on a Twitter Spaces that he calculates term premia below where it was during COVID, which means one of 2 things: deep recession, which Visa is saying it's not necessarily the case 2 weeks ago. Spending's very robust, or a massive lack of collateral in the system. And normally this is a point at which the Fed pivot. I would say the Fed pivot comes in the next 3 to 6 months. That's what my view is. When does the markets bottom? I'm not entirely sure whether it's today. A lot of people are speculating where it is. It's not going to make a difference to what I do anyway, because I think that it's zero sum in the outcome. System goes down, or we've got QE for longer in spite of inflation. And in that environment, I want to own assets. I don't want to own cash. I don't want to own liabilities. I want to own fixed rate debt. I want to understand where my liabilities are, and I want certainty on that. I don't want variable rates all over the place. So I want certainty on my liabilities, and I want all my cash to be in assets. And that's essentially how I position the portfolio. A lot of these companies are interest rate sensitive, or inflation hedges, like attached to crude oil or Bitcoin in terms of CleanSpark and Bitcoin itself. A lot of these are essentially sensitive to interest rates and liquidity in the system. And if I'm right on this, and I do believe that I will be over certainly the time horizon, I think this portfolio will do incredibly well. And that's sort of where the bigger picture comes from. I am massively surprised at how far it got. But look, you can see the damage that's happening. The United Kingdom is now, you can see in international markets, the risks that we've seen because of a very strong dollar, sovereign debt crisis, possibly in the United Kingdom, which is, I think you guys can understand it. Okay, it happens in Sri Lanka a couple of weeks ago or a couple of months ago. Sri Lanka is a very small country in relative terms regarding GDP and consumption to the United Kingdom. Okay, not to say that that's not tragic, but it's not going to impact global markets. United Kingdom is very different. United Kingdom is a net importer, and so it's going to impact global markets, and that's where it gets really sort of tricky in terms of where we currently are. And then that being said, when we look at, for argument's sake, the S&P 500, it made a lower low here, but a number of discretionary companies within our portfolio, they're significantly off their June lows, whether it's Crocs, if you look at XHB, home builders, you can see that it's making higher lows here. It didn't make lower lows. A number of companies within the portfolio, PayPal, these are more discretionary focused companies. It looks like they already bottomed last June. And what's kind of dragging the portfolio down a little bit has been anything that's sensitive to interest rates. So Builders First Source has started building this out at about $60. It went down as low as 52, but it looks like it's starting to recover. I still think it's a fantastic and cheap company and it'll do very well. But in the near term, a lot of volatility. Why? Interest rate sensitive. Same situation with MI Homes, didn't make a lower low. It's a home builder, so you can see like the index broadly is quite the index broadly is looking quite strong. As well as that, if we look at XBI, biotech is ultimately what was one of the first to turn back in February of 2021. This year is very strong off its lows with a much higher low. So I do think we're at the point where we're going to start to see nibbling of risk taking. I do think you can see across the board. These are ETFs, by the way. These aren't individual companies. So XBI is the biotech ETF. XHB is the home builder ETF. XLY is the discretionary ETF. Again, these are not making lower lows. What is making lower lows are some of the generals. So Apple, well, maybe not some of the generals. Apple's not making a lower low, at least not yet. But Microsoft, big weighting within the index is making a lower low. Google, big weighting within the index is making a lower low. Interestingly, Amazon is not making a lower low. It's more discretionary focused. And so you can see as of right now, it does look like we are internally, you're starting to see certain sectors that should be making lower lows if recessionary risks were rising, putting in higher lows. And so, look, there's been a lot of pain this year, but I do think we're at a point where, C is possibly changing. I don't know if we're absolutely at a bottom yet. In fact, I think there might actually be a little bit more on the downside. I know we're up quite a bit. It doesn't really make a difference. I'm not going to be changing anything because I own each individual company for different reasons. But yeah, possibly one more lower low. We'll see. It doesn't really matter anyway. I think it would be more near term. I think we now have a sort of ticking time bomb in terms of when the Fed actually pivot. And for those that believe that the Fed won't pivot because of high inflation, you probably didn't believe that the British would actually pivot 6 days after they did. Not just pause interest rates, but actually start with $5 billion in QE every day in perpetuity. So that's 6 days. So things can change pretty quickly. And I do think that with a bankrupt balance sheet And as of right now, when you start to draw down that $692 billion from the TGA, you're going to end up with a situation where the US governments are not getting at buffer and tax receipts, has to issue a deficit, has to produce a deficit, issue bonds, and there's no natural buyer. International markets are selling $7.5 trillion. The Federal Reserve is selling $8.8 trillion. And commercial banks, SLR, there's no SLR relief. The supplementary reserve ratio essentially includes reserves that the central bank print and is sitting on the balance sheet, those assets in the SLR. So you need to keep a cash buffer, including those reserve ratios. Whereas in Europe, Basel III doesn't include those reserves. So in the US, you have a massive situation where they got to hoard more and more cash. There's a gold-plated financial system in the US where there's over 6% in terms of loan loss reserves. And so if there was SLR relief, there's a big pile of capital that could finance that deficit. But the Federal Reserve and the US government, they're not even going down this route, which is crazy because 15 months ago, Jerome Powell said he was going to start working on SLR relief. 15 months later, he's done absolutely nothing. I do wonder, though, whether it has something to do with last October, November, when central banks were told that they couldn't hold risk assets, whether it was bonds or equities. It seems to be like they've made a lot of bad decisions since then, but we'll soon find out. So anyway, that's essentially where we are. When we look at the companies in the portfolio, look, my biggest problem right now is I want to buy everything, and I don't have a money tree, but I'm very excited about the medium to long term. There's a lot of companies in this portfolio. I like all of them. I really do. I like all of them. I would like to buy all of them, but there is one company that I want to bring to your attention because I have 3% available. I was thinking to myself, why don't I just sink it into Transocean? And I was like, maybe I should build out a bigger position in Lennox International. And then I was looking at other companies that are currently out there like Copart, just a wonderful, wonderful business. And I was like, well, maybe I'll put it into Copart. And then I was thinking maybe I'll put more into Pool Corporation, which again, is just an incredible business. For context, Pool Corporation has compounded since inception, including the drawdown, at 20% per year for greater than 20 years. And that includes the 75% drawdown during the global financial crisis. So as of right now, like, it's a very solid business, even though it goes down, because of the nature of the business, there's a lot of non-discretionary income that goes into it. You buy it at a fair price over a long period of time. You make a lot of money here. So Pool Corporation, I was like, maybe I should buy more Pool Corporation. So I'm looking at the entire portfolio. Overstock is currently trading at 2.5 times its net cash position. We paid 4.5 times its net cash position. I thought that was dirt cheap. $44 is the average price we paid. Is trading at 24. That's 4.5 times its net cash position. That's not including the residual value of its e-commerce business. It's not including Medici Ventures, where I think most of the upside is. And so all of these, I'm wondering, like, why don't I build these out? But there is a company that I have been following for quite some time, and it's just got to a point where it's just bizarrely cheap. I follow a lot of companies, but this company anyway is a company called Medifast. And so I'll bring your attention to this company. It's a company that sells weight loss products, and they also do coaching, but it's kind of a distributor where other players in the space, whether it's Herbalife or whatever, it's kind of like multi-level marketing type business model. It's not the case for Medifast. They've got coaches, and the coaches upsell the products, and they're the distributor. And so their margins are a lot wider, and their business is a lot more consistent. It was originally founded back in the 1970s by a doctor for his patient that was clinically obese, eating the wrong foods, and constantly felt hungry and whatnot. So that's essentially how the business started back in the 1970s. It's not a new business, it's been around for a very long time. But very briefly, I just want to show you guys some of the metrics of this business because it's very, very, very rare. So when you pop on over here to ratios, it gives you a good idea of the amount of cash that this business is able to produce. And then we'll have a look at its valuation. Return on assets is essentially it's total assets divided by its income. Return on assets, 35%. It's an asset-light business. It's got a high return on those assets. Return on invested capital, forget about the last couple of years. Look at it historically in a normal year, 35%. That's incredibly high. If you listen to Charlie Munger, what did Charlie Munger say? Over a long period of time, the share price normally reflects the performance of the return on invested capital. So if you look at Medifast, it's down significantly, about 70% off its all-time high. But if you look at it long term, it's up about 20x since 1994. But if you were fortunate enough to buy it at a discount, which we're going to look at in a moment, for argument's sake, in 2008, where it's currently trading at a similar multiple, you made 2,222 times your money. So the compounded growth rate of this company has been absolutely astonishing long term. It's a very consistent business because I think, is it 66% of the US population is clinically obese? 90% of the population have a doctor's note so that they don't have to join the military because of some sort of health complication. It's a huge, huge market in the US. And so it's got a long runway. So when you're looking at the return on invested capital, these guys essentially invest $1 and they're able to produce about 35 cents on top of that every single year. In the last year, they've just been able to do incredible numbers, $1.10 on every $1 invested per year, which is pretty insane. Return on equity is shareholder equity divided by your net income. Again, close to 100%, but in normal markets, it's still up around 20%. Very, very, very attractive. Gross margins above 60%. So remember what we were saying about inflation in a previous call. If you look at inflation, let's say you've got a company where your revenue is $100, right? So you have $100 in revenue. You got $40 in cost of goods sold, meaning your gross profit's $60. Now, if you have 10% inflation, so if this goes up 10%, 10%, what does that mean? Well, your new cost of goods sold is now $44, but your gross margin is still 56. It's still pretty high. So if you have 10% inflation, it's only going to impact you by about 4%. So you're only going to have to increase prices by about 4%, not 10%. It's a lot easier to pass on those costs. And so at 72.8%, despite higher inflation, these guys are still going to print cash. And that's a very, very, very sort of interesting predicament to be in. As well as that, when you think about the business, how it's performed, it's been phenomenal. It's in a very sticky industry with very somewhat non-discretionary spend. Back in June, they announced they're going to buy back $100 million worth of stock, which is a significant amount, given that it's $1.2 billion in market cap. Now, a lot of people might say stock buybacks are useless, and they are if you've got a bad capital allocator. We'll talk about why it's very good for Medifast to buy back their stock, certainly $100 million in just a moment. But let's say I earned $100 as a company. Let's say corporate tax rate's 20%. So the company will end up with $80, right? This is why I hate dividends. This is why dividends are so dumb. When people tell me I don't have enough dividend exposure, it's hard to bite my lip. So there's $80. Let's say all of those dividends are sent to me. Now I have to pay tax. So we've already paid 20% in taxes. Only on the $100 of net income, there's $80 left over. Now the company's going to give me that $80 and I'm going to pay 50% in income tax. So what do I get at the end? I'll end up with $40. So that's a 60% tax to give me that as a dividend, right? So what the company could do instead is take that $80 and just buy back the stock. What does that mean? Less outstanding shares. What does that mean? Okay, at some point in the future, if you want to distribute dividends, there's less shares, meaning the dividend per share is a lot higher. I don't like dividends. I like buybacks. And when you've got a cash problem like Medifast certainly did in a lightweight business, they don't have a huge amount of cash, about 60 million. But in a lightweight business, it's definitely having that much cash or having that much buybacks delivers fantastic long-term results if you pay the right price for it. So let's go to valuations here and let's have a look at price to earnings ratio. You look at this long term. So the all-time low, this is factoring in the global financial crisis lows. So remember, the last time we traded at these prices, back in the global financial crisis lows, what was the return up until the present day after a 65% decline off the recent highs? Just to show you guys that. This here is down 65% or so off its highs. I believe this is down 66% off its highs. If you bought it in 2008, you're still up 2,220%. Incredible returns, just insane returns. So what was the expected return? 2,200 at these multiples. Now, if you look at this during mid-cycle, right? So if you look at this, let's take those peaks out. Let's just look like mid-cycle. What's the average price the market would pay? 15 times on average. Yeah, about 15 times. So back in sort of May, June, it was trading at 10 times, a 30% discount to its average rate outside of those big, massive blow-offs in terms of the multiple. So is that $100 million in buybacks at a 10x multiple going to give shareholders long-term fantastic returns? Absolutely, I believe so. So I'm looking at Medifast for that 3%. It's a wonderful company trading at really cheap valuations, and I think it's going to do incredibly well longer term. I have a chart structure that lines up. There's, if we have a look at the chart structure in and around here, it looks like it might be putting in a low in tandem with the mark, both on the weekly, suggesting exhaustions here, perfect buys, exhaustions, and on the daily. So I'm very interested in this as of right now. I think it's a great business, very cheap, really good, high quality. You can see it from its metrics. I think it would slot in really nicely. Even if it's only 3%, I think it would slot in very nicely. Okay, there's some questions. I'm going to get straight into questions anyway. Regarding the portfolio, I'm very happy with it. If you guys have any questions, I can see Overstock's in there. If you have any questions on any portfolio position, just throw it in and I'll answer it. There's nothing in the portfolio where the fundamentals have changed really meaningfully. When the fundamentals change, I do react. Like, for argument's sake, when we look at Zillow, we closed this at about $35. Why did we close it? Well, as interest rates push higher, which happened in the space of like 2 months, ultimately what that does is it locks in homeowners and it locks out home buyers, and the market goes stagnant. And when you've got a business model where, if you looked at it, they're sort of, some of their KPIs are actually improving. The number of view hits on their site was up 5%, 6% year on year, but the revenue is going down. Why? Challenges outside of their control. So I love the business. I love the management team. But you've got a very, very unhealthy US housing market where it's completely seized. We need more supply, and slowly home builders will be able to supply that, but it'll take a lot of time and transactions will be very low. So when something's wrong, I will get rid of it. But if it's not, like, I have no reason to get rid of these companies. I just added a little bit more to Meta more recently. I think it's just a fantastic opportunity. There's only 2 companies in the portfolio where if revenue came down, the net income could go up. Facebook is one of those. Amazon is the other. Why? Research and development, capital expenditure is so high, massive expenditure right now, that scaling back would drive higher it would drive higher the net income. So Facebook just announced that they're going to cut back 10% of costs, and they got an upgrade. $11 in GAAP earnings is what we're expecting next year. Analysts were anticipating $9.80 for context, so that's a big difference. And so despite the market environment, what's going to happen to net income for Meta next year? It's going to grow. And so I think over the medium to long, it's a massive cash cow of a business, and I think a lot of people are tripping over themselves because of what Apple done to them this year. But I see Meta as a fabulous long-term opportunity at these prices, which is completely bizarre. The reason being is it doesn't matter what Meta or Facebook do. You can go back to Oxford or the Cambridge Analytica scandal back in 2018. There's big campaigns. Let's get off Facebook. Nobody got off Facebook, and the reason being is the network effect is massive. So if you look at Facebook, why do people not leave? Well, they know that Uncle Vinny is on the site and they haven't seen Uncle Vinny in ages, or Cousin Tito, he's on the site as well and they haven't seen him for ages. And so they know anyone they want to find, they'll be able to find on Facebook. And that's why people don't leave the site. That's the massive moat network effect that they have. The problem is targeting ads. And on the Joe Rogan show, Mark Zuckerberg said that they could actually fix that if they wanted to, but they believe that they need to pivot not away from the same business model, but they need to change and build out the infrastructure. I think the way in which he said it was they're trying to replace Google. So Google's like the 2D internet, the sort of 2D page form. And I think they're trying to build the infrastructure for people to build companies and content and whatever on top of the metaverse, which would be 3D. It's a different user experience. And that's where Facebook's spending a lot of the money. As well as that, they're spending a crap ton of money to catch up on TikTok in terms of their engagement models. They're spending a lot of money on that. That's ending this year as well at the end of the year. So you'll start to see free cash flow grow out as well. So I added a little bit to that. In the near term, it's definitely getting punished. But I think over the medium to long term, it'll be perfectly fine. My time horizon historically was 12 to 24 months. The one thing I recognized this year was volatility is going to be a lot higher. That volatility can create opportunities to buy much cheaper companies. Never thought that Facebook would be below 140, but there you go. Volatility will be a lot higher, and I think time horizons need to be a little bit wider. And so I'm kind of looking at 1 to 3 years in terms of time horizons. And yeah, I'm not concerned really with anything. I think we're at the point where we do start to see a little bit of a change. There's a couple of questions here, so I'm going to get straight into it. But anyway, if you have any questions on the portfolio, ask away. Lala, love to see more of you. Okay, there's no question there. What are my thoughts on Trulieve? Look, I don't have any up-to-date thoughts on Trulieve, but on the cannabis sector, Ricky Sandler was saying of Eminence Capital, Ricky Sandler has about $8-9 billion assets under management. Their sort of buy-side sort of internal research says that the industry in terms of revenue will grow 500% this decade. That's fantastic opportunity, but the challenge is the financing. In my view, Safe Banking Act makes a big difference. We've been waiting for it since 2017. It's still not here. Safe Banking Act would essentially drive revenue of these companies. Why? Because they could refinance, let's say, off that venture capital private equity loan of 8-10% down to, let's say, market rates. Well, today it's probably a lot higher, but it's going to be a lot lower than that private equity rate. MSOS, I do think it's bottomed, and oh no, it hasn't. It made a lower low. I don't know what's driving share prices in the near term. I think the fundamentals are very strong in this sector as a whole, but I don't know about the granular details of each individual company. Raz, still not interested in Google. I see Google as a bureaucratic, complacent company, personally, and the way, like, my concern would be with Google is that they've got such a comfortable business. They've got pretty much a monopoly on search, a duopoly in advertising. It's kind of like an oligopoly now with Amazon as well, but I just see a lot of complacency with that management team. I'm listening to, like, for argument's sake, Snowflake's CEO came out and he was asked a question on his conference call, and he said that the most difficult company to work with is Google. They're very, very, very difficult. The easiest company is Amazon, different work culture. The most difficult is Google. I hear these sort of anecdotes, and it definitely makes me concerned. And as well as that, there's another reason why I was kind of a little bit put off Amazon or Google. When you look at Google, look at the return on invested capital. It's pretty good. Historically, it got down as low as 8.7%. But when you're looking at relative to Facebook, Facebook's doing like 30% consistently year in, year out. The question is, why is Google not being able to do 30-40%? Well, I think maybe this was part of their strategy, I don't know, but I think what they were doing is buying early stage competitors and sticking it on a shelf. They done 275 acquisitions. Almost all of those went to zero, literally goodwill on the balance sheet. And so I wonder, maybe that's part of their strategy, but I don't see where the growth opportunity comes from. With Facebook, they've invested in fiber optic across the coast of Africa, built out infrastructure across India, 2 growth markets for the next 100 years. As well as that, they're looking at 3D and metaverse. As well as that, they're looking at the hardware in order to drive that with Oculus. Combining Control Labs and Oculus together is going to be very interesting. They're starting to add a bunch of features to WhatsApp that can now start monetizing it. I just see a lot more interesting opportunities with Facebook. I know it's a really, really hated company right now, but that's kind of the reason why I like it as well, because either I'm seeing a rough diamond or it's just a very cheap company, and it'll probably compound at the rate of growth as the market. But I think it's going to exceed expectations over the next number of years, similar to what Apple done. Back in 2015, 2016, Apple was just a hardware company. And then Apple started to dominate in services, and very quickly they had $50 billion in revenue coming from services with higher margin. And then it gets re-rated. As of right now, it's trading at 25 times price to earnings, while the market, equal weight S&P 500 market average earnings is 14. So remember, yes, a lot of people are quoting S&P 500 earnings. There's 504 companies in the S&P 500. If they were all to be equal weight, it would be about 0.2%. each company weighting, but it's not. 7.6% is Apple. So Apple has a disproportionately higher influence on the valuation of the index. And so when we look at the S&P 500 multiple, when everyone's saying it's very high, it's not a fair reflection of every company at all. There's a lot of companies in that index that are single digit PE or low teens. And if you're looking at the equal weight index, the average multiple is 14 times. So, yeah, I think valuations have already reset. Personally, I just prefer Facebook. And I know that might not be very popular, but that's sort of where my head's at. don't worry. The video is you'll be able to watch the video again. The same link will work again. And I put it on unlist for copiers, and then I will make it public after. The reason why I've done it is just to make sure that anyone that's copying the portfolio that had a question would be able to squeeze in those questions, and I'd be able to give you guys enough time, more specific than getting a bit off track. So yeah, don't worry about that. Teza, Rob, in your last stream, you mentioned that Overstock had some near-term tailwinds. Can you elaborate on them? I'm not sure specifically what I said in terms of near-term tailwinds, but what I did say is I thought the fundamentals have gotten better over the past 2 years. So when you look at Overstock, the first time I bought Overstock was at $61.87 in November of 2020. So this is where I first bought Overstock. $61.87 right here. That was my first purchase. Okay, it was December, but anyway, it was right here. $61.87. And then it went up 75%. So what did I put in there? I put in about 2.5%, 3%. I thought it was a good play on the e-commerce business. It was cheaper on a comps basis. And T0 was a kicker that could generate a lot of returns that made it very exciting. Went up 75%. I cut the position by 30%, and I didn't do anything with it ever since. I sat through all of this. And then with Overstock, what started to happen was the fundamentals of Medici Ventures started to get better. Before, Overstock were trying to manage it. So Jonathan Johnson bought in Pelion Ventures to oversee it. 99% ownership goes to Overstock. 1% is the general manager fee. That goes to Pelion Ventures. Pelion Ventures then, with the help of Marco Hodes, brought on board David Goon, who was a 30-year veteran over at ICE Markets. They built out the board with the CSO and founder, our CTO and founder of ICE Markets, and ICE Markets invested in the business. So ICE Markets is a it's probably lower now. It's a $51 billion company. It was 65 at the time anyway. Intercontinental Exchange is the parent company of New York Stock Exchange, and T0 is essentially, think about like the New York Stock Exchange, but as well as that, what they can essentially do is provide liquidity to illiquid markets. Like, let's say I want to do a real estate syndication. I don't need to do a limited partnership. I can actually list on T0, and I can do aftermarket sales. So let's say I buy shares in this real estate syndication. I don't have to wait for a closed-end fund to end in 5 or 7 years or whatever. I can essentially just go to the secondary market and sell it. And that's what T0 provide. That doesn't exist right now. Same with venture capital, same with private equity. Those markets get opened up. The wrapper, TZROP, that's what's got a brokerage license. That's what's SEC regulated. So you have a SEC regulated wrapper, which will do a lot of the transactions on a platform with a management team that has plenty of capital that can execute at a time where all its peers are getting a dagger in the back. So the fundamentals of T0 and Medici Ventures broadly, including BIT Global, and Medici Land Ventures as well. Medici Land Ventures is trying to solve the issue of transferring the titles of ownership of a house a lot more effectively. So the fundamentals anyway have gotten a lot better, from Grain Chain to all of these. Mind is another social platform that we own, and that these are all marked at $0. When Overstock got down to $54, I increased the position. When I got down to 47, 48, I increased the position. When it got down to 39, I took a much bigger position. When I got down to 26, I added some more, and then I've got no more cash to put into it. I've got a very big position, average cost $44. So what exactly did we pay for it? $9.50 per share in cash. So we paid $44. That's what we paid on average. And that was $11, by the way. Some of that went into buying back stock, right? So the company bought back $75 million worth of stock. So some of that cash went towards buying back the stock as well, which gives us more ownership. But anyway, $9.50 in cash. We paid $44 on average. Yes, we're down pretty heavily right now, but we paid, less than 5 times its net cash position. Is about $30 million in debt. And so when we're looking at Overstock, did we overpay for it? On a cash basis, I thought 4 times cash was fine, given that I fully understand their e-commerce business. And the e-commerce business is really interesting because you have a situation where it doesn't matter if the revenue dropped 50%. It's essentially a lightweight drop shipping business where they don't hold any inventory. They just connect sellers with mom and pop stores and do a transaction. And the margin is about 5%. So the margin is pretty consistent. The profitability is going to be variable based on the amount of sales that they do. But that reduces risks massively, because what actually leads to bankruptcy is default on debt. They have like 10 times or 15 times cash relative to debt. It's just a bizarre amount. And the business model is going to be profitable long-term because of the nature of it. So that there, we're paying less than 5 times its cash position, and the e-commerce business should continue to produce cash. So far this year, it's produced about 40 million in Q1 and Q2 in operating cash flow. And as of right now, it's trading at 1.3 billion. So it's a company, that e-commerce business, I think, is undervalued, massively undervalued. And then when you look at comps on T0, all of the comps that went public in IPO were like 10, 15 billion dollars. And that's where I think in, let's say, 3 to 5 years, T0 will be, where it's spinning off into a public company and it's raising capital at a valuation of somewhere between 10 and 15 billion. We own 55% of that. Will there be more dilution? I don't believe so. I think the next dilution might be an IPO, because the company have 250 million in cash in the bank, and they're starting to roll out as of right now. So when you work back, I think there's $150 per share in value in T0 alone. And that's not including the cash at $9.50 or what the residual value of the e-commerce business or the rest of the VC Ventures. I think it's deeply undervalued. Sure, in the near term, I look like I've got an egg on my face, but I think in the long term, I'll probably win on this. So that's essentially what I paid for it. The market has been very difficult this year, incredibly difficult. I can tell you, it doesn't matter how much experience you had. Charlie Munger doubled down with margin in Alibaba at $155. The guy has like 60 or 70 years experience, and Alibaba's trading at $80 right now. So it doesn't matter how much experience you have. This year has been challenging for it. Doesn't matter who it was. Overstock's down 50%. I'm perfectly fine with it, because I believe that liquidity is cyclical. We're getting close to that liquidity popping higher. The fundamentals of this business have actually gotten better in the last year, not worse, when some of their peers has actually gotten worse. So you look at Bed Bath & Beyond, for argument's sake, much worse, where there was a news article where they're cutting back in terms of air conditioning in their stores because they couldn't pay the electricity bills. Fundamentals are getting worse, so the service gets worse. Customer goes elsewhere. At the same time, you've got 20 million houses right now up for renovation based on the age of the house. And by 2025, that'll increase to 25 million. So that market, that business is only going to get better over the next couple of years. When sort of liquidity comes back, I think you get a re-rating of the multiple. Jonathan Johnson is incredibly savvy. I think he'll probably buy back some more stock down around these prices. That'll give us long-term fantastic returns. And I think we make a new all-time high in overstock. And at $44 per share, it doesn't matter if it gets to 100 or 200 or 1,000. It's going to, in my view, I believe it's going to generate a very significant return on an annual compounded growth rate basis, even from when I bought it back in November. That's the way I look at it. So it's, in my view, it's a fabulous opportunity, and it just needs a little bit of patience. Dominic's asking, have I ever looked at ALGN? Is that Allergan? Align Technology. No. Allergan, I used to own Allergan, actually. Allergan sell like breast implants and stuff like that. And then I got very lucky. There was a problem in France where they put the wrong silicone into it and people were suing them, but I got out just before that. That's why I brought that up. But anyway, that was a number of years ago. No, I don't know anything about Align. Health Technology. Health Tech, ALGN. Health Technology is very interesting. I'll tell you why. It's kind of similar to like filters and stuff like that in the pool industry. IP is very important because you can get like 1,000 patents on a piece of hardware. I don't know if these guys have hardware or not, but it can protect the industry really well, and it can produce cash flow, consistently over 20 years. It looks like the metrics right away. Maybe an asset-heavy business. Well, not asset-heavy, but like return on equity. You'd want good would be 5%. Great would be 15%. Anything over 20 is phenomenal. Even at 17, it's fantastic. It looks like a pretty solid, decent business. Strong return on capital. High margins. Yeah, it looks really interesting. Just skimming over those numbers. Now, it looked to me as though Medifast had better unit economics. And and it's trading at 10 times earnings. This is obviously a different industry, different margin, different multiple, but this is trading at 22 times. All-time low has been down around 14.7 times. So yeah, I mean, it could be very interesting, but it's not on my radar as of right now. It looks like it got absolutely pummeled. It doesn't look excessively expensive, but I mean, the market average is 14 times. So I think if you can get those type of metrics with consistency, like what I like about Medifast is it's to some degree it's non-discretionary spend, right? So it's staple products. They sell supplements and stuff like that for weight loss, and they do it through, I think it's like 59,000 or something like that, trainers. So that business has got some sort of non-discretionary element to it where it's your health. This probably the same, but I can get similar sort of metrics investing in Medifast for 9.5 times earnings today. So there is a lot of opportunities out there. The market's very exciting right now. And it's funny because this is where everyone's running out the door and bitching and fighting with each other, when if you can take a deep breath, stay composed, gather a little bit of capital, invest it today, your expected returns moving forward will be a lot higher. But people don't think rationally, and that's the biggest problem. Yeah, it caught me off guard, but this year for sure. But I still believe that equities are still a good bet. Will I be buying more Royal Mail? I was actually thinking about it today. So I'm just going to overlay that comment there from not Raz, but Dominic about Royal Mail with, I've got a list of comments here. One from Kevin. Kevin's asking me, so let me just pop this in. Kevin's asking me a question here. So I'm going to post that, and then I'm going to stick it up there. No, not Lars. Sorry, Lars. I'll get to you in just a moment. Can you also talk about Royal Mail as well, Rob? Am I still optimistic on the company? Okay, so Royal Mail have two segments of their business, and they've got 3 geographical locations. Segments of their business is letter and package delivery. Letters, structural decline. It's not really a big business anyway because it's a couple of cents per letter. Yeah, they've got a lot of volume, millions of letters, but a lot of the revenue is actually coming from package delivery. So when you're looking at something like Royal Mail, the question is e-commerce going to speed up or slow down? I think what happened during COVID was we brought a load of growth forward in e-commerce, and now we're mean reverting and it's slowing down. So you got a little bit of drag in terms of demand over the past 2 years in the e-commerce space. At the same time, energy costs increase pretty aggressively. So when you're delivering packages and diesel or gasoline fueled cars, the cost is increasing. They're having challenges with the labor unions as well. All of these are not very good in the near term. They're a little bit of headwinds. However, the company have a plan to raise rates this year on packages and letters, and raise rates next year in 2023. What's the probability that the volumes will remain reasonably elevated? Now, it is cyclical. They're essentially delivering packages, right? Which is from e-commerce. In a lot of cases, it's discretionary spend. And in the United Kingdom, it's not a good market right now. But those package volumes might be low in the very near term. But consider that rural markets, they've got a monopoly on those rural markets, which have a pretty decent margin. And 52% of the entire package volume in the UK is controlled by Royal Mail. So they've got like a very dominant position there as well. In Europe, they got GLS, and then they own some railroads over in Canada. So those 3 different regions, Royal Mail are pretty dominant in. So I think medium to long term, the package delivery space, the e-commerce space is kind of hit a speed bump because we brought so much growth forward. A change, a pivot in terms of spending. It went from goods to services, and that obviously impacts package delivery. So Royal Mail in the near term had a couple of wobbles, but this is essentially what I was looking at when I bought Royal Mail. The way in which Warren Buffett looks at a company is he really cares about the return on equity. So what's the net worth of the business, and how much income do I make based on that net worth, essentially? So what is equity? Equity it's the book value of equity. You've heard book value before. And because this is an asset-rich business, I like to look at the book value. So it's assets minus liabilities, and that'll give you your equity. That's the net worth of the company, the book value of shareholder equity, and it's $5.334 billion. Now, this can be a little bit. You got to do a little bit of work here, because if you go up to the assets, you look at something like goodwill as an example. Goodwill is a very erroneous asset. It's a very erroneous asset. I don't know why we use it. It's garbage. I think we should get rid of it. Goodwill is essentially, let's say there's a house, its market value is 100,000. No one wants to buy it. The owner doesn't really want to sell it, but it's only worth 100,000. I'll offer him 120. All chances are he takes the 120,000. My balance sheet looks like $100,000 in an asset, $20,000 in goodwill. That's what I overpaid for the asset. You're never going to materialize that. So in a bankruptcy, goodwill it's not worth anything. So I don't know why we account for it. It's a total trash metric. So you got to be very careful, because there are companies that have huge amounts of goodwill. It's an imaginary sort of intangible asset that doesn't exist. In this case, they have 428 million pounds. It's not really a big dent. It brings us down to about $4.9 billion. And if you look at the cash position, 1.2 billion. If you look at including receivables, they've got another 1.6 billion. So they're pretty liquid in the next 12 months, over $3 billion. Now that's where the price is today. It's at £1.94. Is that where it closed? I don't think it closed there. No, it did. It doesn't show. Today was down 3.5%. But the market cap anyway is 1.835 billion. So I have 4.9 billion in tangible assets that's going to produce a specific return, net income on that over the medium to long term. So if we pop on over here and we have a look at financials and we look at the ratios. So before we're talking about return on equity, this is really important. So when you're looking at return on equity in the normal cycle, you're looking at like, I don't know, come down here because it's just a little bit of a mess up there, but you're looking at like 3, 4, 5, peak of the cycles up around 10, but let's just say 5% on average if you're going to hold it for 5 to 7 years. They have pricing power. There's going to be cyclical ups and downs, but on average, let's say 5% return on equity. Well, if I pull up a calculator, which you guys won't see, and I put in $4.9 billion as the tangible book value, and I multiply that by 0.05 for 5%, the company on average should produce 245 million pounds. 245 million pounds as of today on a $1.835 billion market cap. That's a single-digit price earnings multiple, but the residual value of the company, which is the railroad, GLS, Royal Mail, is 4.9 billion. So I have the net worth of the company, the assets, plus it's going to produce a yield of about like 14, 15% every year for me. That's at today's prices. Now, what I paid for the company was 0.6 times tangible book value. And as of right now, you can see just how cheap this has gotten. So since inception, the cheapest it was actually in and around where we are. So this is the tangible book value, excluding intangibles, whether it's IP or goodwill. And you can see the all-time low, which is probably during COVID, or maybe it was more recent, I'm not sure, was 0.32 times. The average is about 1 times book value. If you take that jump out, the average is around 1 times book value, which is the replacement value of its assets. So I paid 0.6 times book value for the company. And the reason why I thought I was getting a good discount relative to its average of about 1.3, whatever, you can take all this down, it's still up around 1. The reason why I thought I was getting a pretty good deal was because of strikes, because of fear over energy costs, because of fear over margins in the near term. But you have the risk of a sovereign debt crisis over in the United Kingdom, and that's massively impacted all assets in the UK. So this really fell off a cliff as well, and it continues to sell off. Strikes going ahead, sovereign debt issues. There's a lot of challenges in the near term, but the company has $4.9 billion. It's not a huge position in the portfolio. And that's why I diversify. People say to me, diversification's for idiots because they heard it on the internet somewhere. This is why I diversify. I buy a company with $4.9 billion in tangible assets that on average in a normal cycle will produce about 4 or 5% in return on equity, meaning 245 million pounds every year. That's my cash. So I was paying 10 times earnings at around 0.6 times book value. I thought I was getting enough value, but a lot of challenges happened since then. I think the company is bizarrely cheap right now, but I don't know if it's going to bottom right away. So has my view changed on Royal Mail? No, but there's a hell of a lot of challenges in the UK and Europe right now. That being said, things can change rather quickly. If the Federal Reserve were to pivot, the dollar started to depreciate. The United Kingdom is essentially, they're a net importer, so they need a stronger British pound. Fuel prices have come down a hell of a lot. If you look at UK oil, which is Brent oil is down off its high of $138. It's currently at 89 right now. So energy costs have come down. I do believe that very quickly things could turn around with a little bit of liquidity. But as of right now, you got a lack of liquidity, a lot of negative sentiment. But when you're looking at the assets and the potential return on those assets is still very attractive. So the question is, will I be buying more? I would love to buy more, but I don't know if we're out of the woods yet. I think it's deeply undervalued. I think it'll solve itself out over the medium to long term. And so I don't want to sell it, not at these prices for sure, but I'm not sure if I would be increasing a position as of right now. AMD, cheaper than your last buy position. Micron, AMAT are enough. Yeah, well, they're all sort of different. Micron is obviously memory, Applied Material, which is more of a commodity. Applied Materials supply machines to make semiconductors. So the reason why I am and we're bullish Applied Materials, if you go on social media, everyone says one thing. They say Applied Materials is a zero. And the reason why Applied Materials is a zero, well, not a zero, but it's going down essentially is what you hear. But the reason why it should go down, according to everybody, is because the capital expenditure cycle is about to diminish. Well, this is what I think a lot of people are missing. Apple, a couple of weeks ago, maybe a month ago, they decided that what they're going to do is scale back the manufacturing of watches, iWatches, and iPads in China and redistribute that over to Vietnam. Maybe last week or a couple of days ago, they decided that they're going to scale back manufacturing of iPhones in China and start manufacturing them in India. People are so this idea of deglobalization doesn't mean everything is produced in the United States. What it means is supply chains are changing and companies are going with more allied regions where they're fragmenting their production and they're going with countries that are more favorable. So if you look at Vietnam, yes, the United States went to war with Vietnam, but Vietnam also produced a lot of goods and services for the United States. And at the same time, they hold a lot of US government treasuries. So they're aligned in their incentives there. And so as we start to see that sort of deglobalization, how are you going to manufacture all these goods, all these products and services, not services, but products? You're going to have to build out your supply chains there. And the backlog of orders is at an all-time high for Applied Materials. And on the latest earnings, they said over the next 3 quarters, demand is way higher than supply. The market doesn't give a shit about that right now. And I'm not going to fight with the market about it because I believe that it'll be fairly reflected in the not too distant future. As liquidity comes back to the market, this is a liquidity phenomenon. But this is a company that continues to execute. So I do have a decent exposure to semiconductors already, bigger position in Applied Material than I do in Micron. But both of those, I think, are pretty systemic moving forward. The thing about Micron is it's getting crushed as of right now, but they're still profitable. It's trading at 1x book value. It's replacement value for all of its assets. The reason why that's important is because you have a choice. You can go out and spend $46 billion to build out foundries, and it's going to take you 7 to 10 years to do that, or you can go out and buy Micron. And so that's why I think it's deep value right now, because memory is the lifeblood of the IT sector. Doesn't matter if you're developing connected vehicles. It doesn't matter if you're developing goggles, which Pekka Lundmark over at Nokia believes is the future outside of phones when we're looking at 6G. It doesn't matter. It's all going to require data to collect. It's all going to require data and memory to collect that data. And there's only 5 different players. And one of those on the leading edge of technology is Micron. So I think these companies are basement bargain prices. I think there's this sort of perception on what's happening in the space. Deglobalization is driving not necessarily consumption, but it's deglobalization and changing supply chains is what's very bullish for Applied Materials. And Micron is the lifeblood of the sector. So AMD is very sensitive to China, and that worries me because look at what Apple's doing. They're moving away from China. That being said, I think it's TSM that does an awful lot of their manufacturing. I can't remember right now off the top of my head, but I think it's in China. But anyway, the US government banned the sale of AI-capable chips in China. Now, AMD, it doesn't impact them at all, but that could just be the start. You know, Pelosi flew into Taiwan, and at the beginning, the administration over in China were saying they're going to blow up her plane if she goes there. So that'll tell you how fragmented those relationships are. The backlash so far as Apple starts to move away from the country as a manufacturing hub, yes, they're still important, but you're starting to see a changing behavior. The banning of AI chips. And I think Lisa Su, the genius behind Lisa Su was she was able to create economies of scale by leveraging China. But these guys, like, here's the thing. They don't produce anything. They're just a design company. So It'll be interesting. I don't have the answers to it. I haven't been looking into it recently, but yeah, it's definitely looking cheaper. What are my thoughts on the impact that a recession could have on Meta? How sticky are their marketing revenues? Okay, so recession, let's just talk about that for a second. GDP came in soft Q1, Q2. The reason why it came in soft was imports. As you can see, earnings held up incredibly well all year. Earnings in the latest report, FactSet's no small business. They're a $16 billion publicly listed business, the data company. But FactSet reported that, what did they report? 77% of companies beat on the top line, 75% on the bottom line, something like that. But anyway, here you can see here their earnings revisions haven't come down. Earnings are still very strong. Spending is still very strong. Corporate profits still quite high. And I think that surprised a lot of people. Many people were expecting Q1 to have revisions, then Q2, then Q3, and now we're heading for Q4. I don't know. We'll see. We'll soon find out. Apple obviously downgraded today. It is definitely a risk. One thing I'll say, though, is if you're looking at the yield curve, with high inflation, I wouldn't be looking at the 2-year bond yield versus the 10-year. And the reason being is if you go back to the 80s, it's not going to show it here, but if you go back to the early 80s when inflation was quite high, this inverted about 1.5 to 2 years on 2 occasions prior to a recession. And I think one of the main reasons is the real yield curve was still positive. So if you look at shorter durations, if you look at the 3-month, which is actually more consistent, it didn't actually invert. And so if this inverted, it would definitely give me a little bit of wobble. But at the same time, I think the important thing to recognize is everyone told me to sell Crocs on the lows. And the reason why we should sell Crocs is because we're going into a recession. The earnings are going to be downgraded. And this is sort of my view on that was when you have a look at Crocs, okay, when you have a look at a company like Crocs, it was trading at 4.6 times earnings. It's still only at 6.7 times earnings. And they've reaffirmed their guidance, but it's trading at 4.4 times earnings. Let's say earnings came in 50% lower than what was anticipated. It's still only less than 9 times earnings in a industry that trades at 17 times earnings. So still deep value. And so if we were to go into a recession, kind of lost what your question. Oh yeah, it was about Meta. If we were to go into a recession, some of these companies are so cheap that even if you downgraded earnings, essentially, I think a lot of it could be priced in, and that's certainly the case with Crocs. This is still about 45% or so off those June lows. I think so. Yeah, it's about 57% still off those June lows. It just got way too cheap. It just got way too cheap. And it just started screaming higher. So a lot of the companies in the portfolio, including Overstock, are very like Crocs. Crocs is one of the first ones to start moving. I'd like the rest of them to start moving pretty soon because I'm done with this correction. But yeah, the fundamentals of the business haven't changed. Regarding Meta, as I mentioned at the beginning, Meta is one of very few companies that have a very high capital expenditure. So if we went into a recession and revenue slows down, what I mentioned earlier was if revenue comes down, that's essentially what I'm talking about. If revenue comes down, this company could actually put up higher earnings numbers. And the reason being is their capital expenditure is absolutely huge relative to their income. So if you look at capital expenditure, $30 billion, which is a little bit more than, I think it's about 30%. It's just a little bit shy, actually, of 30% of their total revenue. Their EBITDA is 51 billion, so it's like more than 50% of EBITDA. It's gigantic. It's huge. They could scale that back 10% or 10 billion. And so even if their top line slowed down and it impacted their bottom line, they'd be able to offset that. And I think that's ultimately what they've been doing. So now we're expecting $11 in GAAP earnings, according to Jefferies. Analysts have an average of 9.81, so that needs to be upgraded pretty soon, back to $11 and then flat year on year. So that'll be interesting. So yeah, I think that they're in a very unique situation where they could actually offset that. Not every company has that solution. Lars, what is my reasoning behind investing in CleanSpark instead of increasing your position in Bitcoin? Why do I not rotate? A good question, because I was thinking about it. My Bitcoin into CleanSpark, for example. Would love to know a bit more about my thought process. Okay, I have a very big personal position in CleanSpark. So CleanSpark is, so I'll tell you, I didn't increase my investment in digital assets. I had a decent sized position. So going back to the reasons why I'm bullish on Bitcoin is for the reasons I opened this there's so much debt in the world that you can't help but have high inflation, high expenditure, and low interest rates, meaning your savings are worthless. You need hard assets. Bitcoin, gold are hard assets, whether you like it or whether you don't. The reason why Bitcoin's all over the place is behaving exactly as it should in a tightening cycle. But as that liquidity comes back out, it should be like an elastic band. And so I bought that in 2018 for that reason, when I began to realize, holy smokes, it was more actually specific to Europe at the time, but I began to realize the colossal mess that we're in. And you can see it with the Bank of England essentially raising interest rates and then 6 days later doing quantitative easing. It's bizarre. It's absolutely bizarre. Credibility goes to zero. So when I'm looking at Bitcoin, that's essentially why I think it's going to go up. With CleanSpark, I recently cut my Bitcoin holdings in half, and I put that capital into Bitcoin miners, CleanSpark, and some into Hut 8 mining. I prefer CleanSpark, and so I've got a very big personal position. If it goes to zero, 4% of my net worth disappears. But I think these have 20 to 40x on the upside. And I don't see another risk to reward opportunity over a 3-4 year time horizon, quite like digital asset miners. So I've increased my risk there quite significantly. The payoff, I'll never need to work again. My kids may not even need to. If it gets up to like 40x return, it's just bizarre, the potential returns. If that risk to reward wasn't there, I probably wouldn't do it. But when I'm looking at CleanSpark, this is a company, again, going back to the book value, because when you look at a lot of Bitcoin miners, they went on a spending spree using debt, buying overpriced companies. So if you look at something like CoreZ has $1 billion in goodwill and $1 billion in debt. The balance sheet's horrible, and it forced them at the lows to sell 69% of all of their Bitcoin. So CleanSpark's not in that situation because they mine Bitcoin, they sell it to finance operations. They will issue equity only to buy another business, but they're buying other businesses where they're buying the manufacturing rigs or the Bitcoin mining rigs at about $2,500, $2,700 per miner. Whereas you go back 1.5 years ago and the market was charging $9,500 for that. So they're buying massively discounted rigs. As of right now, they're mining 14.5 at a peak intra-month Bitcoin per day. If I go back to when I bought it, they were only mining 10. So the improvement in the number of Bitcoins that they mine is up 45%. And so this is a business that is set up in the next bull market to generate disproportionately higher amounts of Bitcoin and much higher free cash flow at a bizarrely cheap valuation. So let's have a look at the company. It's currently at $151 million in market cap. And if you look at its balance sheet really quickly, almost all of its value is in its assets, its plant and equipment. So if you look at, okay, depreciation, they have a lot of equipment they can depreciate it. It's pretty good in order to hide some of that net income. But most of their assets, they have $411 million in assets. 360 million of that is plant and equipment. It's Bitcoin miners. So they've $411 million in assets, and it's all for Bitcoin mining. And then they've got $34 million, a little small amount of debt in there as well. $34 million in liabilities. So shareholder equity, what you and I own in this business is $375 million, but today you only pay $150 million for that. And so to me, that's a very, very, very appealing valuation to pay for it. And I'll tell you why in just one moment. So we're paying 0.37 times tangible book value per share for CleanSpark. In other words, if we were the residual value, if we were to liquidate all of their assets, would be roughly 376 million at market prices or at book prices. What's in the book? There's not a lot of liabilities, so all that would go to common equity holders. So we would still make money in that scenario if we could sell those mining rigs at a reasonable price. So I think I get enough value in the company. And then you got to think about, okay, what does it cost for them to mine a Bitcoin all in? $6,500. So if we do get quantitative easing 5, which we're already seeing it around the world. So if we start to get it in the United States, what's the chances Bitcoin gets over $100,000? I think it's pretty darn high. If it happens before the halving, well, then their free cash flow is going to be a lot higher. If it happens after it, it probably goes up to about $15,000 per Bitcoin mined. That's not necessarily bad because it's going to price out an awful lot of levered Bitcoin miners, meaning the hash rate might drop in the near term, meaning it'll be easier to mine Bitcoin. And so anyway, what I'm trying to say is in the last bull market, the market was paying about 30 times book value. I don't think we get to 30 times book value. I think we might get to like 3-4 times book value, but the disproportionately high amounts of cash flow that this company can produce would mean that you're looking at shareholder equity return on equity of like 40 to 60% per year over the next 4 years if we get above 100,000. I just think it's a fabulous opportunity. At 3-4 times book value, you're looking at like 30 to 40x on the upside in share price. I know it's quite hated as of right now, but it's so goddamn cheap. It could go down another 50% for sure, but it's so goddamn cheap. If you believe that there's a sliver of an opportunity in Bitcoin, a higher beta play would be something like CleanSpark. And the chart structure also seems to line up. The mark also seems to line up. So yeah, I really do like this. From an LEOA perspective, you're looking at 183 on the upside. From a sort of, about 4 times book value, based on greater than $100,000 in Bitcoin, you could be looking at like $120, $150 per share. That's bizarre to think about. And so even if like that position went to zero, to have a 40 to 1 risk to reward, it's irresponsible not to go after it at a time where you're seeing central banks already pivot. And the correlation between global M2 year on year and Bitcoin is very tight. So I think it would be very irresponsible not to go after something like CleanSpark. And that's why I increased my position. Why don't I do it in the portfolio? I've very much been thinking about closing Bitcoin and putting it all into CleanSpark. And I might actually do that. But yeah, I really like it. I love CleanSpark. But yeah, that might be something that I do, increase CleanSpark. Okay, so considering the loss of value of the euro versus the US dollar, how would you feel about investing in European companies which get most of the revenue outside of Europe? So I think that, okay, this is a really good point. So you have what's known as the Plaza Accord. Plaza Accord was on September 22nd, 1985. So we pop on over here and we have a look at, if we have a look at trade weight USD, trade weight US dollar. Okay, does this go back far enough? So this won't go back. Darn. We'll just use the DXY. This is pretty much just the euro, though. 68% of it's the euro. It's better to look at the trade weight dollar index, broad preferably. But anyway, it doesn't matter. We had a Latin American debt crisis back in the 1980s, and in September of 1985, you had G5 members come together, lock themselves in a room, and they agreed to sort of manipulate the value of the dollar down. And you had a mega crash in the US dollar. Well, we're at a point now where there is a chance that we might see some sort of Plaza Accord. Now, we did hear from a Fed official that said we're not going to get a Plaza Accord, but I wouldn't read too much into that. And the reason being is, as you've seen last year, Powell was saying inflation is transitory. Then he said 75 basis points 3 weeks later. No 75 basis points. 3 weeks later, does 75 basis points. And then you look at the Bank of England, where last week they raised interest rates and 6 days later they're doing quantitative easing. It just seems like a clown show of really unqualified people. So I wouldn't listen to anything the Fed say, anything, or any central banker says. I think there is a real chance that we do get some sort of Plaza Accord. How would they do that? Swap lines, swapping one currency for the other. That could be a way. How they could also do it would basically have swap lines is one way. The second way could be essentially looking at relative interest rates. The United States could cut interest rates at a slightly faster pace than the rest of the world, balance out the rate differentials. Another way would be the U.S. government actually increase a wider deficit, spends more money, dollars released into the market. There's a lot of things that could happen. And the risk of a Plaza Accord is quite high as of right now. In 2016, we had the Shanghai Accord. I think it was in Shanghai Accord. Okay, communique, whatever you want to call it. We'll call it the Shanghai Accord. It was in 2016, October 2016. So the dollar got very strong in 2016, and you had the Shanghai Accord, where central bankers met in Shanghai. That was kind of like a mini sort of devaluation of the currency, as you can see there. And so from time to time, central bankers can essentially create some sort of scenario where the dollar can actually weaken. We're at that point where the global system breaks. We're at a point where the US dollar is going to be, at least for another decade, the global reserve currency. but we're also at a point where things can break. And if they break, it's irreparable damage. And so there is risk of a Plaza Accord. And so, yeah, you could buy companies that have disproportionately high revenue internationally, but I think you could also buy company, like I wouldn't touch the euro. Like I'm not saying this is a buy the euro moment. I'm just saying that those risks persist and you could be buying at precisely the wrong moment, which is very typical with investing. I think you need to buy a business that in its own right is a good quality operator. There's a lot of Swedish businesses that are good quality. Poland is very interesting, really interesting. Turkey is very cheap, 4 times earnings for the entire index with exploding exports. So there is places that could be very interesting, but there is a chance at these levels that the dollar starts to roll over. And that's certainly, I think we're at those sort of nosebleed peaks. We'll see now. This is going to be end of day. We'll update. But yesterday we had a 13 exhaustion. We're on 10 of 13 on the daily. See the weekly. This is pretty consistent as well. Yeah, they're still ongoing with 7 of 9 and 12 of 13. So there might be a couple more weeks of sideways consolidation. But I think we might get closer to maybe a little bit of a reversal in the dollar. We'll see. Capital flows to the strongest economies. That's why I always invest in the United States. And I said this many times. Everyone wanted to stray off and go into emerging markets in 2021, into China, all of these different places because they were relatively cheaper. But the US always fares off better. And it doesn't matter. Like you can look at is it the German DAX GE30? GER 30, yeah, German DAX. Year to date, this is showing that the German DAX is only down 22%, while the NASDAQ is down 30%. Yeah, right, that's not true. This is priced in euros. So when I multiply this by euro dollar, to get the dollar amount that it's down 35%. So European equities are bleeding pretty hard. There is actually one company, FDR, Fluidra, is very interesting here in Spain. Very similar to Pool Corporation. They've got some international revenue as well. This is a very interesting one as well. It's that they're a Spanish company, but they've got a lot of international revenue. That could be very interesting as well. So Fluidra, yeah, there are companies. Sweden's very interesting. One company that's on my list to have a look at, Evolution. These guys are in the gambling space. Got some U.S. international revenue. Charts, like it's again, when you're looking at the metrics of these businesses, there's something in the water in Sweden, but the management are just phenomenal over there. Every business looks exactly the same, where you have, really strong return on equity, really strong return on capital, really decent return on assets, very strong margins. Okay, don't look at gross profit, but if you're looking at operating margins, they're still very strong. 58% in operating margins is insane. But this is a high growth business as well. Well, a reasonably high growth business. It's in the gambling space. Question about ethics there, you'd have to ask. But, companies like this, very interesting, really, really, really interesting. Evolution, which is now the right time to really consider it. But, I'm looking at a lot of businesses right now. Look, I look at them all the time, whether I'm interested in buying them or not. But, yeah, Europe has some very interesting plays, whether it's Fluidra, Evolution. There's a lot of good quality companies inside the Poland ETF, where, yeah, they might be richly priced, like 20, 25 times earnings, but like the metrics are phenomenal. It's a relatively, they've got one e-commerce business, I can't pronounce the name now, but like their metrics, return on equity, 60%, return on assets, 40%, return on invested capital, it's trading at 20 times earnings. You don't get that in the United States. It just doesn't exist. And so, yeah, there is opportunities if you go across borders, but you're taking on a little bit more risk as well. Dominic, just been looking into Med. It looks fantastic. Yeah, I agree. I've been following it for a while now. Actually, I'll tell you right now, I've been following Medifast, and I was considering buying it at about 160. So, because it was only trading at 10, 11 times earnings, maybe 11, 12, something like that. They did downgrade earnings a little bit, but yeah, now it's just looking bizarrely cheap. So it could be very interesting for sure. Alex, if you have time, could you suggest some books, authors that you've found valuable? Let me see. I have a couple of Audible accounts. Let me just see if it'll show some of the books. Let me just open it over here in case there's any sensitive information on it. So let me, okay, I have 0 credits. Okay, I know that. So listening to a book. So listen, history. Let me just see. I'll just show you some of the books that I have. Okay, this is in this account anyway. I've got a couple of accounts, but in this account I'm listening to The Outsiders at the moment. Richer, Wiser, Happier, Psychology of Money, Titan, Economic History of the World since 1400, The Art of War, The Rise of Carey, Persuasion, 48 Laws of Power. That's what I have here. My phone's on charge in the kitchen, so I don't have my other one, but there's some books that are very interesting. Yeah, I'm really enjoying The Outsiders. I'm almost finished it. Richer, Wiser, Happier. I left the last hour. It's kind of repetitive, but it's pretty good. And then Psychology of Money. Got 20 minutes left. I've listened to Titan once, so this is the second time. It's like 36 hours, so it takes a little bit of time. But anyway, there's some books that you might find helpful. Great to see you excited. Yeah, I've never lost the excitement. I think going back to what people say about like being on YouTube and stuff like that, when I reflect on YouTube, if you look at like last year, the retail investment community got absolutely roasted in the sense where, if you had a YouTube channel, like people offered me tens of thousands every month to do videos on stock picks because they were trying to dilute the shareholder, whether it was brokerage platforms, like money's thrown at you. And if you don't have your wits about yourself or you have cash in your pocket, a lot of people were taking that money and they were in the casino. And the problem is, like, think about this. Get 3 free stocks if you sign up to this platform. That's a casino. Put $100 in, scratch your lucky lottery ticket, and let's see what you get. That's not promoting quality investing. And if you look at that type of behavior and everything around it, it got so toxic that my head was spinning. That was ultimately why, like, there's so many reasons why I closed the YouTube channel, but I was like, there was a comment that I wasn't going to touch on, which I'm going to touch on right now. But there's a comment here that was asked, and I'm not picking on this person whatsoever, but I'm not going to say who it was. But I'm just going to take this comment. I'm not going to mention anything else because I'm not here to sort of give anyone a hard time, but this is a comment that I received and I just want to put it up here. This is part of the comment. You see in there, it's asking like Dropbox. It's asking about Planet 13. It's asking about Tattooed Chef. Well, more specifically about Tattooed Chef, I sold that 2 years ago. That is a trash company. But let me just show you something about Tattooed Chef. It wasn't always a trash company. These are another company that got caught up in the hype. If you look at the financials and you have a look at the company's operating margins, when I bought into the company, it had an investor deck and it had a historical track record of positive operating margins. It was a profitable business. And what the company started to do was very shady activities. It was newfound wealth for the owner. He started giving money to lawyers, like gifts, like just ridiculous amounts of cash, like tens of millions of dollars. Very shady stuff. They started buying white label companies with no margins to keep driving the top line revenue. And this is probably a zero. And not only did I speak about this at the time, but I had like a back and forth argument with their investor relations department, which I think they hired school children because it was so immature, the way in which they were talking about the business, the way they handled themselves. And that was all on YouTube. I sold this out at $22 a share. And today it's trading at $5 a share. And so I get these questions all the time, like, what do I think about this stock? I'm like, you can't buy a company that you don't feel comfortable knowing where you're wrong. Like with Zillow, yeah, I took a big loss on Zillow, absolutely. But I knew the minute interest rates pushed higher that it was game over. I wouldn't make my money back. I was down 50% on that. I wouldn't make my money back in the next number of years. It'd be better off somewhere else. With Overstock, I'm down not quite 50%, but not far away from it. I'm almost certain I'll make a multiple based on what I paid for it. My conviction hasn't changed there because I understand the business. And so what was happening was all this gambling attitude, including this, where it's like, should I sell Tattooed Chef? Well, why'd you buy it? The fundamentals deteriorated years ago. This is a car crash. the gross margins of this business, I believe on one quarter anyway, it went negative, but like 6.4% gross margins, negative 25% operating margins. Why? They're buying white label businesses to keep that hype. Top line revenue growth. Yeah, we want profitability. And they were growing their brand, their specific Tattooed Chef brand, which had the higher margins. They were doing everything right until they went public, and they got super greedy. And you can see it in the performance. They became greedy little pigs, and they ruined the business. The business is a zero. And the reason why it's a zero is because they're burning a ridiculous amount of cash every year. Cash from operations is negative $78 million in the last 12 months. They've got only $27 million left. And they've got all of this burden with all of these white label products that are losing money on razor thin margins. They focused on a gazillion SKUs. You know what you do when inflation increases? You get rid of all of those products on the shelf that you can't move. The ones that don't sell very often, you get very concentrated in what does sell. You increase your volume, you increase your margin. That's what you do. These guys are like, we'll solve inflation. We'll go from 100 products to 500 products. This is a classic example of a really, 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 really poor management team. And so when I get these comments, which I was getting all the time, like, what should I do with this? I'm like, well, why'd you buy it? Why do you own it? There has to be a reason why you own it. And it can't be, I seen this video on YouTube. If that's the response, I mean, I don't know what to say. It really frustrates me because, you know, it's hard enough to make money in the market, but if you don't have the conviction about yourself, you'll never, ever, ever, ever get to second base. And so just back to that comment, Alex. Yeah, I mean, the market's been very difficult this year, but stepping away from that type of content, they're going to do something very different. I'm going to do stuff like tutorial videos, which I'm working on at the moment, actually. And it's going to be like 3 to 5 minutes, just explaining these metrics, why they're important, explaining how to read a balance sheet. That stuff, I don't know if it's going to be popular or not, but I think if somebody wants to analyze a business, at the very least, they should be able to read a balance sheet. They should be able to understand nuances in cash flow statement. What's the difference between cash flow and net income and EBITDA, and what's return, like why should we consider not just return on equity, but return on capital, return on assets as well? Like all this stuff. I think so. You should understand that, and I'll do videos on that, like 3 to 5 minute videos. But that other content, I realized that, yeah, I'm talking about companies I'm very excited about, but you can't really do that at scale. It gets really messy. It gets really, really messy. And even more so when the entire environment is like focused on 3 stocks for free when you sign up here. All you got to do is put $100 in. That's a casino. And it's a shame that whatever, you don't realize it in the moment, but when you reflect on it, you're like, holy crap, 2021 was mad. It was crazy. It really was. Anyway, cheeky question from Dominic, so feel free to decline. What's the biggest position in my portfolio, my personal portfolio? To be honest, Dominic, I don't indulge. It could, you see, the one that I added the most amount of capital to is Warner Bros. The biggest position, though, as of right now, still have a decent position. I've got like, yeah, so my biggest individual position is probably, it's probably Crocs, still Crocs. And the reason why I say it, I was just trying to think about, like, I was just trying to calculate what I had in Bitcoin and try and figure out what that size of the value is, but I actually cut it in half. So I think it's Crocs. Crocs is the biggest position. Second biggest position is probably Overstock. Overstock, I've got a very big position in. But if it wasn't for big recoveries like PayPal, Crocs, I think I would have been in big trouble. But I think a lot of the other companies are going to perform very well. It looks like today is actually a pretty good day. Anyway, we'll take it. So I think my biggest position is everything in my portfolio is pretty much a reflection of what's in the eToro portfolio, except for Cameco. And the reason why Cameco is not in this portfolio is because they didn't have it listed. When they listed it was actually when it spiked higher, and I actually cut my personal position in half there. So when that spiked higher, I was actually reducing exposure. So I'm not just going to blindly buy into it. So I have Cameco,
Other uranium players that I have, I've got a small position. Paladin, I've got a small position. Not this isn't Paladin. This is Paladin. A small position in FCU and DPLO. Real small positions, but anyway. And then I have Bitcoin. I actually have some Binance coin. Binance used to be in our portfolio as well. Not very lucky, but anyway, it was in the middle of this rip higher here, and I had to rebalance the portfolio, and I never added it back. Some Binance and a couple other digital assets, but the vast majority of it's what you see in eToro. Okay, so there are questions over on the eToro page, which I'm going to answer now. So the first one is, I wanted to do my sort of presentation, if you will, first before we got into the questions, because it'll be easier then to answer them. So this question was, we're down 20% at the moment. Do I have a short-term goal? No, I don't set short-term goals. I think setting price goals in terms of expected returns is a really dangerous idea. That's just from me with experience. There's people on eToro that are phenomenal short-term investors, and this is absolutely their market environment. High volatility, big moves, in and out in a couple of days, and I'll make a lot of money. That's not my game. Can't do it. I panic, I make mistakes, and I lose money. And if I can build conviction on a specific company, and in the near term, if I can understand that the fundamentals haven't changed and what's happening is a drain on liquidity, I can build that conviction to stay patient, and I'll just stay patient. And eventually the market should mean revert. And I'll give you a couple examples because Kevin has a couple of questions that are very good as well. But with short-term goals, like I had some guy mention, I don't know if he's copying the portfolio or not, but mention that, risk management is about setting stop losses. Setting stop losses means you haven't got a clue what you own. Because it's like saying, I'm going to go out and buy a brand new car. I'm going to drive it off the showroom floor. It's going to depreciate 15%. I'm going to get to the nearest roundabout, and I'm going to turn around, and I'm going to do a stop loss and bring it back to the garage and lose 15%. If you understand what you bought in the first place, you don't sell it at a 15% stop loss, which is a random arbitrary number. And the fallacy in that sort of thinking is you're assuming that you get stopped out once and that's it. But that's death by 1,000 cuts. It just means that you can actually lose more money a lot quicker because you get stopped out once, then twice, then 3 times. And before you know it, death by 1,000 cuts, you got stopped out 15 times. Most of your money's gone. And so this idea of stop losses, this idea of short-term trading, it's at odds with sort of longer-term investing. I can sleep at night knowing what I own. And, 2015, which I'll talk about in a moment, was a big lesson for me. It was a very difficult market environment, but it made me have a little bit more conviction in the fundamentals behind the business, the macro environment in which we're operating in, and then having a reasonable time horizon. Before it was 12 to 24 months. I'd say now I'd push it out maybe to 1 to 3 years. But that being said, I do have positions I hold a lot longer. I bought Cameco in 2016. I bought Bitcoin in 2018. So that's 6 and 4 years, respectively, that I've owned those. And so I'll continue holding them. I've held Overstock since 2020, Dropbox since 2020. I've held Transocean since 2020. I only added it to the portfolio in the last year or so simply because, again, the buy button was frozen down here. I couldn't add it. You weren't able to buy it on eToro until after the big move. So I wasn't able to add this to the portfolio when I had it in my personal portfolio. And so, my view is build out conviction, fundamentals, reasonable time horizon, wait patiently, and I'm okay holding something for a couple of years. Everyone told me that, ExxonMobil used to be in the portfolio. And when I bought it down here, I was very confident that normally what happens in commodity cycles is when we go below capital expenditure, when we go below break-even cost, capital expenditure goes to zero, the price of crude oil increases, and then you start to see a situation where the market starts to be profitable again. At the moment, I bought ExxonMobil, and it was overwhelming the amount of people that told me it's a piece of shit company. The ESG crowd are out. The balance sheet skeptics were out saying, look, they're borrowing money for debt. And the reason why I bring this up is if you don't have conviction in the company that you own in the first place, you're never going to be able to sit through volatility. And so in this circumstance, I didn't think the Ukraine war was going to start. I didn't think crude oil was going to remain as elevated as it did. So I ended up closing this. It went up like 50, 60% in a short period of time. Big, massive rebound. I was like, okay, this is back to fair value. I'm going to take some profit. But that's essentially like Citigroup. It wasn't that long ago that people were saying banks are dead and cryptocurrencies are the new bank. Buy Citigroup. I bought Citigroup. Same time I was buying ExxonMobil. Look, if you don't have conviction, you're never going to be able to buy it. And so do I have short-term goals? No, I'm really focused on medium to longer term, 12 to 36 months, and I'll hold on to it a lot longer if I have to, if I think that the risk to reward is still there. But it's really more of a fundamentally driven process. I think stop losses are a loser's bet. I don't think you should bother looking at fundamentals. I think stop losses are great for technical traders, but for fundamental traders, as I mentioned before, it's like buying a vehicle, taking it off the showroom floor, spinning around at the roundabout and dropping it back and taking a 15% haircut. It doesn't make a lot of sense to me whatsoever. What does make sense to me is having 25 positions, all of them, or even 20, or even just 15, but just splitting up that risk and having loads of eggs in one, not loads, but a reasonable amount of eggs in one basket and just looking after that basket. And then, one might go down 50%, but another one might go up 20, 30%. This is the first time where almost everything went down at pretty much the same time, which I'll talk about in a moment. So do I have a short-term goal? No. I'm looking at 1 to 3 years. I think today is a classic example of how sensitive the portfolio is to interest rates. I think we're pushing on a string as to how much tightening we can do. And you can see that from the analyzing the income statement of the government, balance sheet of the government. You can just see how far we're pushing on a string. I think we're pretty much done. And Logan's tweet, which I wanted to talk about earlier, he's gone nuts here because mortgage rates dropped 0.5% today. But if you look at treasury rates as well on the back of QE from the Bank of England, the 10-year bond yield is down 23 basis points, almost 20 basis points on the 2-year. And look, TLT is up, 3.14. Strong moves in equities and risk assets. The portfolio is heavily geared towards lower interest rates because I think we're pretty limited. If I'm right on that, I do think that the portfolio is going to rip, but it's been very painful in the near term. Certainly with companies like Builders for Source, it's up, almost 8% today. Average cost about 60, maybe a little bit lower, maybe 59. But anyway, we're getting pretty close to break even. We only just started adding to this. It continued to push lower. That's really, really difficult to sit through. Same with MI Homes, been adding it the whole way down. I think I've got an average cost, 43, something like that. Got to get back to break even on these, but these are sensitive to interest rates. And with a strong consumer and household and low interest rates, I think today is a glimpse to what I would expect in the future. I just don't know if we're ready to move just yet. So short term, it's not my forte. It's not something that I have a lot of conviction in. Vol's asking about the YouTube channel. I've already went over that. Okay, Kevin has some great questions here. I answered Royal Mail earlier. So we'll start off with question number 1 from Kev. Guys, fire away with some questions if you want to ask me anything. Just dump them into the question segment. I'm happy to answer anything within reason. So Kev's asking, question number 1, have I experienced this sort of portfolio performance before, and how long did it take to recover? Great question, and yes, I did, and that's the only reason why I'm able to keep my sanity. So I done one thing that was really, all my life, the one thing I've done that has kind of saved me in a lot of respects is I've always looked at liabilities, and I've always tried to keep liabilities fixed and then income and growth variable so that I can take advantage of big upside. So back in 2015, it was one of the worst market environments for me that I'd experienced because I had a lot of money on the table, and it just looks like a blip on the chart, really. But this hit me pretty hard, and I'll tell you exactly what happened. So I had 2 years of cash in the bank. I haven't worked for anybody since 2010, maybe. And so I've never had a job, so I needed to be very careful with my spending. And that's one thing that I think is very important. So I had enough cash to be patient. But what happened to me in 2015 was I started a leverage strategy, done very well. Got into sort of August around that time. And inside 4 days, I'm down off an all-time high. I'm down 30. The total portfolio was down about 35, 38% in 4 days. Well, it was down maybe 5-7% from like August. No, from maybe June, July into August. And then in August, this 4 days here, I got absolutely walloped in the face. Peak to trough, I think I was down 35, 38, something like that. And it was pretty brutal. And I closed out of everything. I closed out of absolutely everything. So if I experienced a drawdown, I would say it's been a lot worse in a sense where it happened all at once. And that kind of catches you off guard, because when it happens all at once, like for some reason our brain thinks in perpetuity. That's why I like to go to the gym and exercise, because you kind of give yourself a chance to think about things. But your brain thinks about in perpetuity, and in 4 days, I'm almost going bankrupt. That's what I'm thinking. Closed out of everything. And that was the absolute low that I closed out of it. But I didn't return for a couple of months. And here's the thing. The first company that I put capital into was a company called Freeport. And I had an average cost of like, I think it was like $7.90. It was about $8, plus or minus a couple of cents. I added to it a couple of times. The average was about $8. And lo and behold, just after that in August, a couple of months I take off, bought into NVIDIA, which was doing okay. I also bought Freeport. Freeport, I built it up to a pretty decent sized position. It was like one of my core holdings, 7-8%. And it goes from $8 down to $3.50. Now, the difference between 2015 and today is there was other companies in the portfolio that were doing quite well. Like NVIDIA wasn't as big a position. As an example, at that moment, it was up like 30%. And so I owned NVIDIA back then. I owned Freeport. Freeport went from $8 down to $3.50. And so the rest of the portfolio kind of performed the same over the following 2 years, where it got hit in the end of August. But then over the following 2 years, I was able to deliver really strong returns. It took me about 2 years to deliver a strong return on invested capital thereafter, in excess of 20%. This specific example, I got incredibly lucky, because in February of 2018, I closed out of this position, not at the highs. I got as high as $20. I was around $16 when I got out. So it wasn't the absolute high. It was about 15, 20% off a high. But this was up about a double versus what I paid for it, after being down about 60%. And the reason why I was able to build out conviction is this was priced for bankruptcy. People thought this company was going bankrupt, but they had a cash cost to produce a barrel of oil, which was 35% of their business, of $18.50, including the debt, $36. At the time, crude oil was trading above there. They needed like $1.98 for copper. Copper was trading at about $1.50 or $2.15. And so the 95% of the market was telling me that the free cash flow was growing in real time, while the market thought that they were going bankrupt. I guess the problem was I never increased it to a much bigger position on the lows, but sort of live and learn. It ended up playing out over time, but there was a lot of volatility there. And I just wanted to share that, because after I get smacked in the face in August, I get smacked in the face again. And then over a number of a couple of years into 2018, that's, favorable markets ended up recovering. I put that capital into Disney and I built it out to the biggest position. I paid $100.86 on a spike lower. I guess it was right here, $100.86. I only remember these because they were the biggest positions in my portfolio at the time. Just like, I know all the stats like of all of the positions in the portfolio, but these were the biggest ones at the time. Like I'll remember Crocs now in 10 years and Overstocks and Warner Bros. Because they're the main positions. But this was a key position. Closed it a little bit early, but that done very well. Took maybe 5-6 months to play out. So I've been in this situation before, but I can't remember when I got back to break even. But I do know the returns over 2 years into the future were very good. I was happy with it anyway. I'd have to go back and I don't know what the exact number was. So anyway, look, it's hard. And you don't realize it. You don't realize it until you're forced to reflect on it. But 2015, like I used to have lots of hair. And now I'm like, I've got no hair here, very little hair here. And I think I lost a lot of it back in 2015. It was very stressful. It was a really difficult environment to invest in. But I think when you go through it once and you experience it, the second time it doesn't feel any better, but you're able to deal with it a little bit better. I definitely am a little bit stressed and frustrated. But you deal with it a little bit better the more you go through it. It doesn't get any easier. Raz, your sincerity is highly appreciated. Thank you very much. Really appreciate that. My dad told me when I was a kid, there's only one law. It's called civil law. And you can do whatever you want in this life. But if you hurt somebody physically or emotionally, you got to put it right. So I live by that. I think he was dead right. Okay, this is another question from Kev. What are some of the mistakes you think you made during this bear market? I think it's not necessarily like some of the mistakes. I mean, there's a lot of things like shoulda, coulda, woulda moments. I still believe that my view will end up being right. I think the mistake that I made was, I always believe that I'm not the smartest guy in the room, right? That's the way. Like if I can see it sitting in my small office, exactly what's going on, everyone can see it. That's always been my view. And when I looked at the unfunded liabilities at $100 trillion and needing to run a deficit and high inflation, low interest rates, I'm like, I don't want to touch cash. I don't want to own treasuries. Maybe gold and hard assets. I own enough Bitcoin, but equities make a lot of sense to me. And I think that with the consumer very like in good shape, that makes a lot of sense to me. I was expecting a 10 to 15% correction. I didn't really do much. I probably should have shorted the market, raised some cash. Because sometimes when you go into a correction, things can get a lot worse. And as of right now, the Federal Reserve are really blinded to the mistakes that they're making, which is very surprising to me. So I think if I'm in this situation again, I think it'll be important to understand that the efficient market hypothesis should be scrunched up in a ball, tossed into the bin, because all of the information in the world is not fairly reflected in price. And I think that's what we're starting to realize. People think that interest rates can rise in perpetuity. And they really can't. It's basic math. You can't raise interest rates, terminal rates to 10 or 15% like Volcker, because debt to GDP back then was 30%. Today it's 125%. So you bankrupt the US and the rest of the world. You just can't do it. And so I think next time I'll be a lot more precautious. I was expecting a correction. I did think the correction was done in February. And I didn't anticipate the impact that the Russia-Ukraine war would have so quickly. What I mean by that is, can we look at this versus a year ago? No. We were expecting 1.75% in rate hikes. And just for context, that's into March of next year. And for context, as of right now, into December, we're expecting 4.25 to 4.5%. That's the neutral rate that's increased. I didn't see that coming. So there's a couple of things like that where I think I have the bigger picture right, but in the near term, I could have been a little bit more precautious. I was aggressively getting into some of those companies in hindsight, and I probably should have taken my time a little bit more. So yeah, I think that's a big mistake that I made. Should have been a lot more precautious heading into 2022, raise some cash, and then maybe being a little bit more patient in reallocating it. And then as well as that, realizing that, just because something might look obvious doesn't mean that the market's necessarily going to spot it. And I could say that, quantitative easing in global markets is very obvious. But I would say there's very few people that last week when the Bank of England raised interest rates expected that 6 days later they'd be doing quantitative easing. So things change pretty quickly. So yeah, I think I probably should have raised a little bit more cash. And there's some of there's some of the challenges that I had this year that I probably would have done different. I'm not a trader, so I'm not going to be able to. I'm not like I hedged into COVID, but I started hedging well before. I started hedging in like November. The market continued to push higher, but PMIs were negative. You were seeing relatively tight markets. Unemployment was increasing. We were already in a global manufacturing recession into late 2019. I was already hedged. I missed the last move here, but I was able to, that was very easy for me to spot. This correction on the downside is masked with inflation. It makes it really difficult to spot what's going on. Because behind the scenes, earnings have held up really well, and you can see PayPal are saying sequential growth month over month, quarter over quarter, year over year. And then you've got Visa, who came out 2 weeks ago and they're saying the consumer, but overall spending has been remarkably stable both in the United States and most of the world. And just to give a couple of examples, there has been a shift, obviously, from goods to services. So when you look at something like Target, it's not an indicator. When you look at something like FedEx, it's not a macro indicator. For context, FedEx, back in 2018, were approached by Amazon to do a deal, and FedEx said no, that it would ruin their business. Back in 2016. Today, Amazon had no market share. FedEx had 22%. Today, FedEx have 21% and Amazon have 22% market share. Amazon have massively stole that market with massive capital expenditure. They've added 1 million new employees since COVID, for context. A lot of that went into warehousing, logistics. And so a lot of people are looking at FedEx as some sort of indicator, or listening to Gary Friedman over at Restoration Hardware, who's bloody hilarious. Gary Friedman is one of the most entertaining CEOs you'll ever find. The guy is talking about being alone in a hot tub 1 minute. This is on a conference call. Being alone in a hot tub one moment. He's sort of reminiscing on what happened in the past in his hot tub. And then the next thing, he's talking about The Big Short. And then he's talking about depressions in 1929. And the last 2 quarters, this is 2 quarters ago. And the last 2 quarters ago, they beat by 30% earnings. Last quarter, they beat by 40%. They just knock it out of the park. And everyone's looking at Gary Friedman saying he's a really experienced CEO, but it's not a macro indication. And despite him being very negative, the results are showing a completely different situation. And so you're seeing a pivot away from services into sort of hardware, away from goods into services. Those services are, for argument's sake, I give some examples here, like movies, travel spends very high, theater, restaurants. That's essentially what he's talking about in terms of services. Discretionary spending is strengthening. This is 2 weeks ago. Who has more information as to what the consumer is doing than Visa? And so the backdrop of the economy is still quite strong. And that's essentially what I was like. The reason why I was getting bearish was monetary impulse was M2 on a year-over-year rate of change basis. The impulse, when you exclude that away from, when you exclude it, I can't think of it right now. But anyway, the monetary impulse turned negative, and that's why I was turning a little bit precautious in Q1. But consumer credit was blowing up. And even like Bank of America came out 2 weeks ago as well, and they said that, year on year, credit card growth is up 10%. People are still spending a lot of money. And it's not on, food prices are expensive, but it's not just it's discretionary spending as well. And so it's been a very difficult year for those reasons, for sure. One more question. So this is the last question, and it's from Kev as well. So let me just share this here. Let me pop it in and then put it on the screen. So Kev is asking, do I think we go much lower from here? Do I think we could drop another 20% plus and see VIX hitting 50 or 80? So let's start off over here. If we are to go lower, where is it? If we are to go lower, essentially it's the recessionary outcome. When you're looking at the 10-year minus the 3-month, we're just not in a recession right now anyway. Could that change in the future? From as of right now, the forward PE is 15.8 times on the S&P 500. The average, this is from the 23rd of September. The average for the equal weighted S&P 500, it's around 14, so it's a lot lower. So when you're looking at the valuation, we've already reset valuations. If we don't have an earnings recession and we don't go into a recession, we're fairly done. That being said, the S&P 500 can push lower, and you've seen today what was holding the S&P 500 back. Apple, and people don't really appreciate this. Like, a lot of people are looking at the earnings multiple and saying, we've never bottomed in a market environment where the earnings multiple is at 16 times. Like, people are saying, like, we're at 18 times trailing 12 months. Next year, it's expected to be 15.8 times. We've never bottomed when the multiple was so high. But also, we've never had such a concentrated market, which a lot of people don't really pay attention to, which I think is a mistake. So if you look at S&P 500, the weightings, there's 503 companies, or 504 companies. There's 4 companies more in the S&P 500. It's 504 companies. One company is Apple with 5.47%. Another company is Microsoft with 5.75%. And then you have Amazon. You've got a top 10, I think, is 22%. I'll pull up a calculator really quickly and I'll add these up just to give you an idea. You guys won't see it on the screen, but I'll tell you what it is. So 7.47 from Apple, 5.75 from Microsoft, 3.3 from Amazon. Tesla is 2.45. Google is 2.6 because it's A and B. How many is that? I'm going to count Apple as one company. So we'll go down to 11, which is Procter & Gamble. That was Google. So we've got Berkshire Hathaway here. Add Berkshire Hathaway 1.56 plus United Health 1.55 plus Johnson Johnson 1.41 plus, and this is just rounding it up. There might be a couple of basis points higher than that, but anyway, we'll see 1.16 plus Procter & Gamble 1.03. The top 10 companies, again, I'm counting the two different classes of Google as one. It's 28% of the index. And so when you look at Apple, it's got a 25 times forward PE. Microsoft's higher than that. I think it's something like, I don't know. We'll see now. Microsoft is 23 times. Anyway, outside of sort of, I would say, and I could be wrong, like Procter & Gamble is very high. Procter & Gamble is like 20. Procter & Gamble is 22. Berkshire Hathaway is probably not that high. B or K. It doesn't matter. B or K. But B, like Amazon comes up at 114 as an example because they depreciate a lot of it. Yeah, you don't have price. You do 18 times. Anyway, the top 28% of the index is the top 10 companies, and these have a disproportionately higher price to earnings multiple. So when you're looking at price to earnings multiple, there's a couple of things. A lot of people are saying, like, we need to get down to where we were in the 80s when we had high inflation, 5 to 10 times PE. There's a structural difference there. Today, we've got much more technology as a dominant player, which has much higher margins, much higher free cash flow, and much higher earnings potential. So the multiple is going to be higher for those businesses versus back in the 80s, which it was dominated by industrials and goods, essentially, with lower margins. So very different businesses with very different multiples. And secondly, the weighting of the index is so distorted today that it's very hard to say that we need to get down to 14 times earnings, because that might just be Apple, Microsoft, Amazon, these sort of companies continuing to sell off. I don't think Amazon sells off, but anyway, it's just pointing out there. So yeah, that idea that the multiple needs to get lower, it might be for certain companies, but the equal weight price earnings for the S&P 500 is already at 14. And again, a lot of these companies are software with much higher margins, which normally have higher multiples than hardware companies and industrial businesses, like what we've seen back in the 70s and 80s. So there's a lot of nuance there. So let me go back over the question. Do I think we have much lower to go? I think if we don't go into a recession, and there's a reasonable probability we don't, certainly if the Fed pivot now, well, in the next 3 to 6 months, there's definitely a chance we don't. I don't think there's a huge amount of downside. The other question you have there regarding the VIX at 50 to 80, this is really important. So I follow a guy called Kem Carson. Kem Carson's in volatility. Normally I retweet stuff that I find interesting or stuff that kind of gives me an idea of something that I agree with, essentially. So Kem has said here, and this is really important because everyone's saying, like, this is essentially what he's responding to. No bear market has bottomed without VIX at 45 plus. And VIX is not a product that you trade. You can trade volatility indexes, like you can trade volatility ETFs, but VIX is not something that we trade. But anyway, this was Kem's answer, which is spot on. And I just wanted to share it for people that may not fully understand why VIX hasn't spiked. And before actually we talk about this, if you have a look at the MOVE index, this is volatility for US Treasuries, right? So let me turn this to line, and let's compare this to VIX, which is equity volatility. So this is bond volatility and equity volatility. So let me just put it on a different axis, just so you can see it a bit better. So this is COVID. If you look during COVID, look what happened. Big, massive spike in volatility, both in equities and treasuries. Look at where we are right now is bond market liquidity is absolutely drained. Fed have gone too far, not enough cash in the system. That's the problem. But equity volatility is very benign. Nobody's selling. There's no capitulation. And the question is why, and does this need to catch up with bond market volatility? Kem does a really good really good job of answering that question. So he's tired of explaining this. I understood this through Kem. This guy is been in the industry for, I don't know, 20, 30 years, and he focuses on volatility products. But anyway, VIX isn't a level of fear index, blah, 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 blah. Essentially, the answer is here. Fixed rate vol is collapsing and has all this year, despite the S&P 500 declining. So the idea is S&P 500 declines, VIX has to spike. That's not what's really happened. VIX hasn't done anything. It's elevated, hasn't done anything, but we've seen a lot of volatility in the market. And the question is, why is nobody selling it? The reason being is the world is hedged up to their eyeballs with put options. So the world is already hedged. You and I can't buy hedges like options. But if we could, essentially what we would do is we would buy what's known as a put option. That's an option to buy the S&P 500. We pay a premium for an option, let's say, to buy the S&P 500 at a specific price at some point in the future. Now, if the price of the S&P 500 goes down, the premium increases. Counterpart, or the bank, essentially, whoever sold me, the underwriter of that option, will offer me more money to buy that back off me. And so you end up in a situation where that premium can explode. It's very volatile. So we could put like 2% of our portfolio into long dated puts and just leave it. And if we did have a massive vol event, we could essentially liquidate our position, provide liquidity at precisely the right moment to put it into the market. So where we are as of right now is nobody, big funds, wants to sell any of their equity, probably for the same reason we don't either, because we understand the structure of the market. You know, we've got a situation where inflation is quite hot, interest rates need to remain low, don't really want to hold cash, don't really want to hold treasuries, I'd rather own equities. But at the same time, there are risks, so you'll buy protection. You'll buy some maybe long-dated puts or short-dated puts, whatever. But that balances your portfolio, and there's no capitulation. And so we've grinded lower. Why? What sets the price of an asset is not short selling. It's essentially a lack of demand. The marginal buyer and seller, so let's say you've got an asset. These are all the outstanding shares, SHA or ES. These are all the outstanding shares. That should be E. These are all the outstanding shares. And then you normally have a float that trades. And this is like maybe 1 million shares a day, whatever. Well, you raise interest rates. And what that does is it brings down liquidity, meaning the number of buyers in the market comes down. And so this number of available shares ends up shrinking. So this number of volume comes down. The volume of buyers and sellers go down, but it's in a negative market environment. You're seeing revisions maybe in earnings lower. So you got 60% of the volume per day is selling versus 40% buying. What happens to the share price? The marginal buyer and seller set the share price and it goes down. And that's what we're seeing at the moment. The price is going down because the marginal buyer and seller is more sellers than buyers, essentially. But I think one of the main reasons, I think Kem is on the money. The world is pretty much very well hedged for the current market environment. And that's why you're not seeing a vol spike. So we could see a sell-off in equities. And it doesn't necessarily mean that the VIX is going to go to 45, 50, 100. It doesn't mean that that's going to happen because of the structure of the market right now. It's really weird. Like, it's really, you know, if Charlie Munger can double down on Alibaba with 66 years of experience at $155, bringing his average cost down to 181, this is a bloody hard game when it's trading at $80. And so, yeah, I mean, this year, like if you're confused this year, you're not the only one. It's been a very challenging market. Patrick's saying maybe the better question is, where do you see the most upside right now? Interest rate sensitive assets. What's the problem in the housing market? It's supply. So new home sales, just as an example, but I don't want you to go out and buy this. I want you to buy, like, do analysis. And if it fits your sort of investment framework, we'll then go for it. But, you know, if you look at the housing market, what's the biggest challenge? It's actually supply. And so you've got 5 million millennials coming of age in prime roles where they're going to be earning the most amount of money. And at the same time, as they're earning more money, settling down, having a family, we've got 50, 60% less inventory in the housing market. The Federal Reserve thinks by driving up the mortgage rate to 7%, it's going to bring down housing prices. House prices year on year are still up 7%. So despite having now 6 months of high mortgage rates, nobody's selling. And the reason why nobody's selling is, again, the market it's really unique market where I thought I had it open, but we clearly don't. But if you have a look at wages, like over 90% of household mortgages are fixed rate, and the average yield is 3.3%, right? So today it's at 7%, but that's the marginal buyer. That's somebody that wants to buy today. The average 65% home ownership rate in the US, over 90% of those have fixed rate mortgage at 3.3%. And while they're paying 3.3% per year in interest, their wages are going up 6.7%. So the house has gone from a liability to an asset because it's producing free cash flow. Does that make sense? So homeowners right now are faced with the challenge of, okay, if I sell my house, I'm going to have to pay 7% in terms of mortgage rates because that's where the fixed rate mortgage is. And home prices are down 5% off its high, but still up 7% year on year, despite mortgage rates at 7%. So what ends up happening is the market gets completely locked until we build more houses. We structurally underbuilt for the last decade. And we need to build I think it's 4 million homes is what we're short. So I think that companies like Builders for a Source are well positioned. I think companies like MI Homes, well positioned. Like MI Homes is expected to do $16 in GAAP earnings next year. It's trading at like 2.3 times earnings, even if earnings come in softer, which it might. But Lennar recently came out with better guidance than anticipated. They're anticipating doing 14 to 15.5, was it 14,000 to 15,500 homes? The market was expecting 15,090 homes. So the midpoint was like maybe 600 homes more. So Lennar is literally coming out with much better guidance. Gross profit, net margins, better year over year and quarter over quarter. Why? Volumes went down, meaning the demand for lumber went down. It's the main ingredient into a house. It got collapsed. So the input prices that go in to build a house have come down massively. Now, you don't need to build as many houses because the volume's just gone down. So labor constraints start to ease up. Labor constraints ease, lumber eases, still a lot of demand. You've seen it like anticipated. New home sales of 500,000 came in at 685,000. Pretty insane. And so you've got a situation where the input costs are going down. Home prices are still very elevated. I think it's going to soften. We might see a 10% decline off its peak, but I think it's more so going to plateau. Barry Sternlich, is that how I pronounce his name? Was on CNBC. He was pretty much talking about the real estate market. Echoes my view for sure. Starwood Capital, Barry Sternlich, is that how you say his name? Sternlich. Yeah, echoes my view about the real estate market. We might plateau, maybe go down a couple of points, but the structure of the market is people are locked into their home. And the only way, the only way someone's going to get into a house now with the structure of the market is through new homes being built. And it's structurally underbuilt by 4 million homes. So once rates ease, this is going to be like lighting a match to dry firewood. I think it's going to fly. I really do. Are we there? I don't know. MI Homes, Builders for a Source, and Overstock should do very well in that environment as well. So I think they're very interesting. Transocean, I think, is a $20, $30 stock. The reason being is, like, historically, you look at the last bull market, the return on equity for this company was about 15%. It got as high as like 30%, but let's just say 15%. It got as high as, let me see, in the last cycle. It got as high as, no, it was higher than that. Return on equity. Oh, this is Berkshire Hathaway. I got as high as like 31%, something like that. Return on equity. Yeah, it was like 32, 27. This is as we were declining anyway. But if we get back to like 15% return on equity, which is basically assets, again, same situation to Royal Mail. Let's have a look at its balance sheet real quickly. Disproportionately high amount of property and plant. Most of their assets is gross property and plant minus cumulative depreciation. $17 billion of the $20 billion is property and plant. No goodwill. That's already been struck off. And so you have shareholder equity after liabilities of $11 billion. So return on equity is like, if we get 15% return, if you go back to the last bull market, they had, I think, $15 to $17 billion in shareholder equity, doing 30% on that. That's pretty darn impressive. It's really impressive, $5 billion in net income. But even if we do 15% on the current shareholder equity, companies producing net income, not EBITDA, not depreciating assets, but net income, the company's producing $1.65 billion in cash, well, net income, not cash. But that's about 1 times its market cap. So I think that you're probably going to see book value rise. It's currently at 0.16 times book value. It's $1.75 billion in market cap for $11 billion in shareholder equity. Enterprise value is $8 billion, but they paid down from $10 billion in debt all the way down to $7 billion in debt. So they're repaying debt pretty rapidly. The price to book value is, it was left for dead in 2020. It got down as low as 0.4. It got down as low as 0.4 times its book value, which is bizarrely cheap. It's still very cheap, and I think they're going to survive and thrive. So if you think about that, and then you try and extrapolate what a fair book value, what a fair maybe price to EBITDA, enterprise value to EBITDA would be, I get somewhere in the region of $24 fair value in an upcycle, which I think we're already in. If you listen to Schlumberger, they're saying offshore is growing 15%, onshore is flat. And you can see it from the shareholder investor relations page anyway. Yeah, you'll see they continue to add pretty big contracts the last couple of months, like $321 million in August, $915 million in August. These are pretty big contracts in terms of day rates and profitability. 440,000 plus 40,000 in services, $480,000 day rates. They were anticipating 464. So the fundamentals are way better than where they should be. This is a company I think is $24 is sort of what I'm targeting. That's a pretty good return from where we currently are. And again, I look at these as like, I'd be irresponsible not to own them. So I'm looking for bets where I'm not worried about the volatility if I understand the opportunity. But if I give it enough time horizon, what can I really knock it out of the park with? Overstock, Transocean, CleanSpark, smaller positions, but at the margin, we can look back in 5 years, and if all of these play out like we anticipate, the portfolio might have compounded at like 30%, 35, 40%, which is what I'm hopeful for, but we'll see. We'll find out soon enough, but that's ultimately what I'm looking for. Analyst earning growth for Overstock is fairly high for the coming years. Do I think that growth only applies to Overstock's core business, or does it also factor Medici Ventures? So Medici Ventures will only be accounted for on the balance sheet. They won't. I don't think they have to account for. I think you need over 60% to account for the portion of revenue, and they've got 55% ownership, and maybe Big Global that they have to account for it. But anyway, it's high because there's 20 million home renovations today based on the age, houses that are between 20 and 39 years of age. And that's expected to increase to the highest amount we've seen in, 6 decades, to 25 million. So there is a runway. There is a runway for this business to do very well. We just need credit conditions to ease a little bit. And if they ease a little bit, you can see already, like, interest rates come down a little bit and the portfolio it runs hot. I wouldn't get too excited yet, but that's essentially a preview of what I think will happen. They could be over. They could be a little bit over $100 million. I think it's $120 million a year in cash flow. Might be a little bit high, but I do expect them to do incredibly well. Like I am very bullish on that business. Really bullish. So everything except Royal Mail. And currencies are up. It's very interesting that we had quantitative easing today from the British pound. And I guess maybe there's going to be some more order in the UK. I don't know. Good draw on crude oil today. I think we're bottoming out pretty soon. Rates down nicely. Bitcoin up 2.3. It's not huge, but it's up. And home builders just absolutely screaming today, 4.8%. They're going to be so sensitive to rates. If you have a view that rates are going to go down today, home builders are going to scream. If you think we're pretty capped in and around here and we get down, let's say even to like 5% mortgage rates, home builders are they're gonna scream. This chart structure is very bullish as well. It's an impulsive on the upside. 1, 2, 1, 2, 3, 4, 5, 4, 5. A, B, and C. That's completed. Higher low. So yeah, if you look at all of these interest rate, more long duration assets, they didn't make lower lows. You got home builders here, higher low. XBI, really interesting, higher low. XLY, which is discretionary sector, higher low, but this is, I think, 20% Amazon. So you'll see it looks pretty much the same as Amazon, I think. Yeah, it's pretty much Amazon. So 20%, I think, weighting to Amazon. It's pretty high. But anyway, it's making higher lows. PayPal, higher lows. There's some of them in the portfolio that are like that. That are making higher lows. Not many, but there's some. Lennox International, great company. BioNTech, slight higher high or higher low, but slight higher low in semiconductors as well. Actually, what's SMH? Made a lower low. So yeah. Anyway, guys, if anyone else has any questions, fire away. If not, I guess we'll end it there. I'll give you guys a moment to see if there has. I think there's a little bit of a lag. Any news on the day? Utility truck staging roll. It's a lot of copper demand. Yeah, copper is interesting. Copper actually looks really interesting from our perspective as well. It's got that 1, 2, 3, 4, 5 on the upside. It's looking very much like a reversal. I haven't looked at copper in a while, but it could be interesting. Anyway, I don't think there's much. I don't think there's much else to talk about. Walter's pretty good at technical analysis. This guy's been around since 1964 to 2016. He wrote a number of books. He looks at technical analysis in a very different way, but he's pretty damn good. I've been following him for a while. He's good at combining sentiment with. He does lots of stuff with Brett Trust and stuff like that. But he made a comment earlier today, and he never makes these comments, so I'll give him a like on this for going a little bit out of his comfort zone. But he said, I'm going to break my hard and fast rule and make some forecasts. Per a lot of very persuasive studies, the S&P 500 will be higher 12 months from now. I agree with that. Actually, we can have a look at we're going to have a look at something in just a moment. The events will be heralded by breakaway momentum. Now, if you want, you can read that as well. He has a lot of white papers. There's no way whatsoever to know how low we go. But we'll see. Anyway, it doesn't matter. Jawad Mian. I like Jawad a lot. I think he's a good guy. But he's also very very smart. So Jawad is from Stray Reflections. The Stray Reflections have 10 of the top 50 hedge funds as clients in the world, according to their AUM. Include like Stevie Cohen. You know Stevie Cohen, the guy that got done for insider trading. This guy here. What's his fund? Stevie Cohen. Wow, what's the name of it? He owns the Mets anyway. He seems like a reasonable guy. I don't know. 0.72 AUM. They have like 18 billion. Pretty big anyway. 24 billion. Anyway, he has a lot of big hedge funds as clients. The reason why I bring that up is he's pretty well clued in as to where sort of the market is in terms of bullish, bearish expectations, that type of stuff. I'll leave you guys read this yourself. The guy's name is Jawad Mian, and 23 hours ago he posted the article. But he breaks down his view as to why he believes the S&P 500 will reach record highs in 6 months. I tend to be in the same view. We have different views as to how we get there. He's talking more about the secular impact of markets and how we performed in the last secular moves and sentiments. And it's kind of interesting if you want to look at it. But it says it's an 11-minute read. But anyway, that's something that if you guys want to read, he's quite bullish as well. There's not many of us, so we'll see. Random question. Did you ever look into how to invest in water and water rights? I didn't. Maybe buy Nestle or something like that. I didn't. It's not something. I think that's a very, I don't know, a corner of the world where there's a lot of, not conspiracy theories, but maybe a lot of dodgy dealings going on. Certainly Nestle in the past have had challenges. Yeah. Are Nestle a public company? No? I guess it's not. NESN. There it is. NESN. It's traded in Switzerland, I guess. I think these guys have a lot of water rights. Look, with those type of stuff, I'm not important enough, and I certainly don't have enough capital to get involved in that type of stuff. And I really don't know. I really wouldn't even know how to analyze it, to be honest. So I try and stick in my own lane, to be honest. So yeah, it's not something I looked into in the past, and it's not really something that I'd be too interested in, to be honest, because water rights, I mean, yeah, I think you could probably predict it, but how much upside is, I guess if you look at this, right? So if you look at our job as an investor, this is our job as an investor. If you want to look at it like this, small little town over here, I buy a bottle of water. And that's supposed to be a cap up there. Anyway, I buy a bottle of water for $1, right? So this is what investing is about. I buy a bottle of water for $1. No, I buy a bottle of water for $1 and it's 50% off because the company overstocked and they need to get rid of it. They don't have any shelf space. So in the city, I buy this for $1. And then I drive 10 miles out where there's no stores and it's 40 degrees Celsius. And I sell my bottle of water for $5 because there's no access to water. And so when you're investing, if you think about it in that context, our job as an investor is to buy something for less than it's worth and then sell it for way more than it's worth. And a lot of times, like, your alpha is your upside is the alpha that you generate is your research. And then it requires time to wait patiently to find that guy strolling in the desert that needs a bottle of water that's going to pay you 5 times what you bought it for in the local store. And so you got to buy it when the fundamentals are terrible. So overstocked of water, I get it for 50% off. We're in the desert. There's no stores and you just happen to have a bottle of water. It's worth a hell of a lot more over here to an investor when there's a lot of water. The reason why I bring this up is when you're looking at water rights, in order to make a hell of a lot of money, there has to be, to some degree, there has to be a point at which the market doesn't understand the opportunity. So if you look at overstock, the market doesn't understand Medici Ventures. It understands it's got a retail business connected with the real estate market, which is very challenging, but it doesn't understand that Medici Ventures is there. And that's why it trades at bizarrely cheap valuations today. If you look at something like, I don't know, Transocean, the market looks at the debt levels, high interest rates, and says there's no way in which these guys can operate. But if you look at the political backlash towards operators in the West, the United States more specifically, you realize that doing business on land doesn't make sense. You need to push your operations into international waters. And if you push it into international waters, it'll be a little bit more expensive, but there'll be no sort of regulations or drawbacks or anything like that. If you understand that opportunity that exists there, you got a shortage of crude oil, capital expenditures being down as much as 66% over the past 10 years, or since almost 10 years, since the glut we had in 2014. So capital expenditure comes down, supply is down over the past 10 years, inventories are declining, and consumption's not really going anywhere because we have 1.6 billion vehicles. And for some reason, the cuckoos believe that 1.6 billion people is literally going to transition to electric vehicles. First of all, how are we going to build 1.6 billion? There's 1.6 billion combustible engines. How are we going to build 1.6 billion vehicles that are electric, first and foremost, in a short period of time? Find the capital in order, like, if you think about it, let's say, if that's a 1.6 times 20K, if you're looking at $32 trillion, that's a lot of money that you'd need to swallow up in that market from households. It's not going to happen. And then you've got another problem where the electrical grid is already at capacity. So what I'm trying to say is oil, people believe it's going to zero. It's impossible for oil to go to zero, at least in the next decade. As Jamie Dimon said, we need 100 million barrels a day, every day for the next 10 years. We don't have it. So you need to see the opportunity that doesn't exist. So anyway, long story short, you look at something like water rights, how much of the market doesn't understand that? We need water to live, desalinated. Like there's companies that bought big drilling ships, converted them into desalination plants, and then they head over to Saudi Arabia and they start desalinating water and piping it in to Saudi Arabia out of the sea. You know, there's many different ways to play it, but, you know, how much of that does the market not understand, and what price would you get in at? And that's sort of the question you need to ask yourself. I don't know. Haven't really looked into it either. So really long story, but that's sort of what I wanted to say. Am I familiar with the industry? I am. I'm familiar with that company, which looked pretty good not that long ago. The only thing I'd say about European companies, so they're in the chemical space, Raz. The only thing I'd say is just be careful with electricity costs. Like if you look at the electricity costs in Germany, previously it used to be $20 billion in order to buy energy for Germany per year. So when that goes up 10x, all of a sudden it's 200 billion on a $2 trillion economy. So profit margin goes down significantly. Cost of production goes up significantly. And so that's what's happening across Europe. We know that firsthand. We own a company called Alcoa. They shut down operations in Spain because cost of energy was too high. Shut down operations in Norway because cost of energy was too high. Just got to be a little bit more careful in Europe. Is it Lydon? I can't remember what the Lydon, Lyon, LYB. Yeah, I couldn't remember what the ticker was. Yeah, I looked at this not that long ago and I was thinking it was interesting. The challenge in Europe is energy costs. But yeah, when I looked at it, it looked pretty interesting. I would wait for the next earnings call to see what the damage is on electricity costs, and then you can make a decision from there for sure. EU is just in those specific markets where energy is a big requirement. Yeah, just be a little bit more careful. Energy doesn't need to be a problem in Europe, but we've got political interference and you've got the will of the people as well, which gets in the way. You need energy. You need energy to live. For some reason, people forgot along the way that electricity powers hospitals, powers hot water to get rid of disease. It creates flowing water to get rid of, stagnant, smelly water. Like you need energy for life. In 1900, the average age of a U.S. citizen was 46 years of age. Not because they all died at average of 46 years of age, but early mortality was massive because, medications, because clean running water prevented diseases over the next number of years. That's how our life expanded to like 70s. We haven't really extended our life per se. We've just prevented an awful lot of disease that killed us. So when you think about it, this green revolution, it's the right movement, but people think it needs to happen overnight, and it's doing far more damage. It's doing way more damage than it needs to do. And you can see that in Europe. It's fragmenting relationships. It's destroying industries. And ExxonMobil came out not that long ago, actually on the latest earnings, and they said that in Germany can frack if they want. So right now, nobody, that's a complete no-go. It's a political issue. It's a social issue. Fracking's a no-go. But there is solutions in Germany for fracking. Let me go down here a little bit further. Here it is here. I think there'll be a driver over time to make sure they're leveraging the resources available to them. And I'll make just one example. The potential to see fracking and unconventional gas in Germany. It's potential that they could be more energy independent, but political and social will is what's getting in the way. So look, I don't know where we end up, but Europe's in a mess because of just garbage leadership across the board. And it's not to say that we needed to go down fracking in the route of fracking in Germany, but if you go back, even under Merkel, phasing out of nuclear was a bad idea. Going very concentrated with Russia at 60% of natural gas. Now look at the situation. Nord Stream 1 and Nord Stream 2 just blown up. And I believe that they're not going to be in use ever again. So look, there's a lot of challenges in Europe around energy. There are solutions in Groningen. I think they mentioned it here as well with Groningen. The government just shut down permits on one of the largest natural gas in where was it? In Groningen. More recently. So I think they mentioned that here as well. Somewhere along here anyway, they talk about Groningen. Anyway, there is solutions in Europe, but social and political will is getting in the way at the moment. I'm not saying it's a good idea or a bad idea, fracking or anything like that. I'm just saying there are solutions. We'll see how painful it is, and people will quickly change their mind. So we'll see. I was looking into J.G. Boswell, owner of some of the largest water rights in California, where there's risk of drought in the future. I don't understand water rights or the value it might have. Yeah, it's probably a licensing type business. So if you look at a company like ORGLD, Royal Gold, or these guys are pretty much they're a royalty business. There's another company called Land. Can't think of the name right now. Gladstone, no. Can't think of a name right now. Anyway, they've got loads of land in the Permian Basin. They just collect royalties essentially on the land for gold, oil, that type of stuff. That might be what it is. Maybe they have some natural water. I don't know. It could be just a royalty business though. These can be quite rich in terms of valuation as well, but margins are quite high too. If you look at Royal Gold as an example, Royal Gold's 24 times. It's down quite a bit, actually. It's reached a peak up around 60. It's actually pretty close to its lows from historical standards. The margin on the business is quite high, though. Gross margin, 85. Yeah, there's pretty much no cost. 85%, 50% operating margins. Yeah, it's probably, I'd say, Patrick, it's probably a royalty type business. That's what I'd say it is. But yeah, I don't know. I don't know the water industry at all, so I can't really comment on that. So anyway, guys, I think we might end it there. Unless anyone has any questions, fire away. I've got time. I think my wife already put the kids to bed, so it's not an issue. Equinox Gold's company I was looking at, but it's not on eToro, unfortunately. I think a lot of these still have further downside to go. Anyway, I think we might leave it there, guys. I don't want to waste any more of your time. Markets. Okay, guys. Have a wonderful day. We'll do another one. I think the last one was on the 9th, so in a couple of weeks. There's never really a huge amount to talk about in a short period of time. Right now, it's very volatile. Once we start getting out of this period, I don't think there's going to be a huge amount to talk about. But we'll keep in touch. and we'll take it from there. Okay, guys, have a wonderful day. Looking forward to next time also, Patrick. Have a great day and catch up with you guys soon.